opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it'll take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
Sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel. This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Tom, we were talking about the markets. You described them as a little bit nudgy, some saying range-bound even. Let's get straight to Marvin Lowe. He's a State Street Senior Global Market Strategist. Marvin, first of all, what do you do with dollar right now?
You know what? I think the dollar weakness trend is something that is gaining a bit of strength, even though it's moved a bit. I think we have to look at all the liquidity that's being put into the system, and it's still making its way into it. And with real yields collapsing, there's not a lot of support for the dollar, particularly around the euro, where at least on some of the plans that they've passed, things are improving a bit.
Are some of the risk assets range bound?
Yeah, I think that's a good way to categorize it. Valuation is certainly very, very high, but they've held in there, and they're able to absorb a lot of the ongoing news with regard to the virus, with regard to China, et cetera, and I do think a range-bound type of market is something that we're going to look at going into the end of the summer.
Marvin, the bet that will really affect careers on the buy side is the shift from these 7 tech glory stocks, whatever the number is. Somebody was kidding me on Twitter the other day that it's 6 or it's 7 or it's 9. I don't know how many it is, Marvin. But this one-way bet in the equity market with SPX grinding ever higher versus everything else. When do we get to the everything else?
I think we need clarity on what the economy is going to support. Certainly the amount of liquidity that's in there is making its way into the equity markets. Those bets around, the 6, 7, 10, 12, whatever the number is an easy bet. There are companies that can grow in this market and that are going to be around after that. We don't know what the after that is going to support. Until we're there, I think it becomes difficult to judge that.
Do you believe we will continue to see one day NASDAQ, next day SPX, X NASDAQ? I mean, is this oscillation going to continue through the summer?
Yeah, I think it does, just because the commentary and the degree of uncertainty is still as great as it was months ago, even though we're tens of percents above above from a valuation perspective. So I think that continues as we try to parse through all of this information that's coming at us.
Marvin, how much higher can gold go from here?
Oh, you know what? I mean, it is theoretically there is a limited amount of resources, and it plays into a bit of the concern with inflation at some point in the future, as well as monetary debasement. So it can continue to go higher. I think it's one of those asset classes that becomes a bigger part of your asset allocation as we kind of look beyond, whether it's the next 6 months or the next year before we get clarity.
Marvin Lowe, thank you so much. Greatly appreciate it. It was State Street, their global strategist as well. Really remarkable, folks, to see the VIX come in 23.85. That is stunning off of that 28 to 32 range, and we've really come down to a better place. It will be a better place for those of you that desire a Federal Reserve central bank analysis. Dr. Kacha Lakota of Rochester, the former president of the Minneapolis Fed, in the 10 o'clock hour. Again, futures up and up, continuing up 16. This is Bloomberg.
Quand on voit la mort de George Floyd, on image la mort de mon petit frère Adama Traoré. Et la France va dénoncer tout de suite ce qui va se passer aux États-Unis. Nous, dans le combat vérité-justice pour Adama, vraiment dans le court terme, ce qu'on attend et ce qu'on exige surtout, c'est la mise en examen des gendarmes, la condamnation des gendarmes et d'un procès public. Aujourd'hui, on dénonce le déni de justice qui est en France depuis 4 ans. Jamais, on ira jusqu'au bout, ça fait 4 ans que nous sommes là, nous n'avons pas peur. Ils ont les armes, nous sommes devenus des soldats malgré nous. Face à nous, c'est une machine de guerre qui n'a ni sentiment, ni état d'âme, ni remords. Oui, c'est un mouvement qui se prend, c'est le mouvement du comité Adama, de la nouvelle génération Adama. Aujourd'hui, moi je suis là, nous sommes là, on changera peut-être pas le monde du jour au lendemain, mais on changera des choses.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
None of us are safe until all of us are safe. We need to have a global approach into handling and fighting COVID-19, a global pandemic. Part of this, of course, finding an effective vaccine.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. Tesla is possibly paving the way for its soaring stock to join the S&P 500 index. The electric car maker reported positive earnings for the 4th quarter in a row. Still, that's not good enough for CEO Elon Musk. He thinks Tesla isn't growing fast enough. Shares have quadrupled since March. Unilever reported better than expected revenue in the 2nd quarter. That was fueled by consumers buying hand sanitizer and ice cream. Unilever also signaled the pandemic hasn't hurt its appetite for acquisitions. CEO Alan Hope tells Bloomberg TV the company's been looking for purchases the last 6 months. The parent of Mercedes-Benz expects to make an operating profit this year. Second quarter results signal that Daimler weathered the unprecedented industry slump better than expected. The company is counting on the economy improving and no second wave of the coronavirus. And that's your Bloomberg Business Flash. Tom Prensley.
Ritika, thank you so much. We've been speaking with Marvin Lowe of State Street Global about the clear and present dangers, the clear and present opportunities. But what is out there? I don't mean 2021, but 2024, 2026, with all of this debt buildup. Marvin, there's got to be a price to the free lunch of all the stimulus down the road. How will that affect the trillions of dollars of assets at State Street Global?
Yeah, I mean, I think you're seeing some of that thought process make its way into asset classes. Real yields, if you will, given that only a few months ago we were worried about deflation, we're pushing real yields into this kind of inflation protection zone where those concerns are starting to arise. It's often said that this pandemic is going to change everything. And, I do believe that a lot of how we approach work, how we approach each other, how society integrates is part of that change process. But this is brave new ground. We're all guessing as to how this is going to occur. But, the time now is to think about how that all comes together.
Well, the Reserve Fund of years ago, where I'm going to give them the credit of the invention of money market funds. To me, Marvin, the single U.S. distinction is money market funds. What do money market funds do with negative rates in London? What do they do with a massive negative real rate in New York?
Yeah, I mean, it's certainly one of the reasons why I think the Fed has pushed back as much as they have on negative yields. Zero yield is certainly not great. It's better than a negative yield. Kind of having said that, I think that that reach for income remains a key part of that investment thesis. And more recently, it's pushed into high yield a bit more aggressively as volatility has stabilized. But we have to think about all those different blocks and how to build the type of portfolio that makes sense for us.
Marvin, you mentioned inflation. I mean, do you worry that actually all of this stimulus will lead to, runaway inflation?
You know what, runaway, not necessarily. I think that kind of we've gotten so used to really low and stable inflation that we're not necessarily prepared for even what would historically be, average inflation, if you will, getting towards 2 to 3%. I do worry about it. I think that if the Fed kind of goes into a mode where they've locked themselves into metrics and can't raise rates, if you will, because of yield curve control or something like that, then it could get worse quite quickly.
So where would you see, I mean, if we were to have quite higher inflation, where would you see it first?
So there's a lot of interesting research being done. Some of our academic partners have worked on what the basket of goods people are buying is, COVID basket, if you will. So we're already seeing those baskets not drop as much as kind of these broader inflation baskets that we're used to. So I do think it is in things that we buy. I think food, I think kind of the basic essentials. I used to love to shop for things on sale, like, paper products. They're never on sale anymore. So I think you start seeing it there, and that's where the average consumer gets hit immediately.
Totally agree on that observation. Just anecdotal, folks. The sales have just disappeared. Marvin Lowe, thank you so much. With State Street Global, really, really interesting there in some of these cross-asset dynamics that we see. Futures up 12, up a little more earlier, but we'll take it up 12. Let me give you the levels on that. 3277 on SPX. Dow at 27,000. Up 104 points. The NASDAQ up, I don't know what the percent is. I can't count that high. The VIX, 23.98 is really an extraordinary statistic. Yield market goes nowhere. I stand corrected. Check that. 10-year yield to 4 digits, 0.5889. That bears watching to see if that breaks down. That would be a huge deal. We're not there yet. Dollar weaker. And really front and center is gold with a number of theories out there on what to do with gold at $18.81 the ounce, up a good $15, $16. this morning. Southwest will report. Others will report. Maybe they'll report survival. Robert Crandall has lived a lifetime of 6 deaths of the airline industry. My guess is Mr. Crandall is optimistic. Must listen next with the founder of modern American aviation. This is Bloomberg. Good morning.
Whenever everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, a significant level on the Italian 10-year yield has actually touched. So that bond yield dropping to 1% for the first time since lockdown. Now this, I think, for a couple of reasons. First of all, it was definitely seen as a big victory for the Prime Minister, Giuseppe Conte. The fact that the EU recovery plan was signed over the weekend and that Italy would get some money out of it. But also now we're hearing a lot more detail on how they would spend the money. And Italy this morning also approved a proposal for 25 billion euro in extra spending as it battles to rescue an economy devastated really by the pandemic. And I think these two things combined mean that 10-year bond yield is now at 1%, Tom.
Yeah, really, really extraordinary. Nice report there. And, you know, I really got to say, folks, I find the juxtaposition of Italy and a 1% yield to be extraordinary. I have been so looking forward to this conversation. We are not going to speak with Robert Crandall, the inventor of modern American aviation at American Airlines, about earnings, about revenues, about the doom and gloom of the moment. We're going to talk to him about the Great Pumpkin. The Great Pumpkin was the first 747 I ever saw. I was at O'Hare, and you know it was Brand Affair. And Bob, back then you clowns were flying 747s from O'Hare to Denver or O'Hare to LAX with a piano bar upstairs. What was it like bringing the 747 to the American and the global public?
Well, of course, it was a mistake. I mean, we bought the airplane, which is a long-range airplane, and by the time it was delivered, we were flying it on routes that were much too short, and we said to ourselves, well, what are we going to do with this Great Pumpkin, as you characterized it? And so we put some piano bars upstairs, and that was sufficiently unusual that we attracted some people to get on the airplane and fly around. And of course, over time, as demand got stronger and as it got smarter, we put the airplane on the right routes. It became a very successful plane.
And it's not even possible that a college student from the University of Colorado would try to sneak upstairs to the piano bar. Right now, Bob, a lot of people are not sneaking onto airlines. Southwest Air just out with, I believe, 83% decline in capacity. Bob Crandall, this is a force majeure. What should American aviation do?
Well, American aviation should do its best, and I think all the carriers are doing this now. Look, we only have one intercity transportation system in the United States. It's the airline. COVID has changed people's short-term behavior, but it has not changed people's long-term desire to travel. And so in due course, when we get a vaccine, when we get a cure, people are going to go back and get on the airplanes and go see grandma and go see the places in the world that they want to see. In the short term, the airlines have got a big problem. For the reason you just mentioned. I mean, they're burning cash. People aren't traveling. They're afraid to get on the airplanes. Nobody wants to get sick and nobody wants to die. So we've got a short-term problem which will resolve itself in the long term, but in the short term, the airlines are struggling. They're doing it in modestly different ways. Some are putting a little more capacity up in the hopes that people will fly, and others are doing their best to hunker down and simply cut costs without regard to the revenue. But in the short term, they're all going to suffer, and they will, I think, in the short term get through, and in the long term will hopefully get back to something that resembles normality.
Bob, good morning from London. Is it safe to fly now? I mean, you hear various reports about filtration systems in the air, in airplanes.
Well, you read about filtration systems. You are aware of the fact, I'm sure, that the air turns over frequently. You are aware of the fact that the airlines are doing some extraordinary things to clean the interiors of the airplanes. And so do I think it's safe? Yes, I think it's safe. On the other hand, is it absolutely safe? It can never be absolutely safe, Francine. That's just reality. So I think the airlines are doing all that they can, and I think that people who wear masks and who are careful in terms of how close they get to other people can travel with relative safety. Who knows? Everybody's going to have to make their own decision about that. Up to this point, most people are saying, "Look, I can defer the travel, and that is safer than traveling," and that's probably true. On the other hand, I think as time passes, more people will opt to take a very modest chance and take some trips.
Bob, can I ask you whether business travel will ever resume? So people may decide to travel for vacations and things like that, but it's really the business traveler and the premiums that they pay that airlines need.
Well, they don't need that, Francine. They've just built a business plan which revolves around the fact that there's a certain amount of business travel. I don't think you're going to see as much business travel in the future as you have in the past. The airlines, on the other hand, are probably going to have to modestly raise fares for personal travel because in order to have a satisfactory long-term operation, they've got to have a certain amount of revenue. They've got to have positive cash flow. And they've got to make some money. And that will probably mean in the future, I suspect, a somewhat different fare structure and a different mix of business and personal travel. But they'll figure that out. Things have changed in the past, and they will change in the future.
Bob Crandall, we've just learned that Ann Taylor and Lane Bryant and their parent company have filed for bankruptcy. This is the retail apocalypse in America, folks. Brooks Brothers, of course, a number of days ago. Bob Crandall, you have seared in your memory, I'm sure, that day in 2011 where American Airlines took that path. Is that going to be the easy way out if this extends? Is bankruptcy a constructive process given a pandemic, given a natural disaster?
Well, Tom, you know, somebody said, I don't know the answer to that. But bankruptcy obviously imposes costs on people in our society who have made investments. I don't think we want to create overall a business environment in which every time there is a great crisis, we have a wave of bankruptcies, and therefore people that have made investments in good faith lose their money or lose some of their money. So it's a matter of how society wants to reorganize this particular part of its enterprise. So bankruptcy, I think, in the context of something like the COVID pandemic, has to be looked at in a somewhat different way than it does in the normal workflow of business activities. Now, I personally don't think the airlines ought to have to go bankrupt. I think society as a whole has to recognize the fact that this is a unique business. It is the nation's only intercity transportation system. If we have to subsidize it for a while, we ought to do so as a consequence, consequence of needing that transportation system.
Bob Crandall, see you in that piano bar in the upper deck of a 747. Mr. Crandall, of course, a former American Airlines president and chief executive officer, and indeed chairman. You see, folks, the value of frequent flyer miles and some of that due to Mr. Crandall, United Airlines, dealing with that. We're going to drive forward the conversation with Gary Kelly, the chairman, the chief executive officer of Southwest Air in the 10 o'clock hour. Southwest Air down 40% here from the pandemic. Mr. Kelly has his hands full. Right now, with our first word news in New York City, here's Ritika Gupta.
Thanks, Tom. The world has now gone over 15 million coronavirus cases. The US, Brazil, and India account for nearly half of all infections. Texas reported 197 deaths. That's the most ever in one day. And in Florida, Governor Ron DeSantis says schools may delay reopening if they need time to protect against the risk of the virus. In the UK, a panel of lawmakers say that Boris Johnson's government had no economic planning for the pandemic. According to the House of Commons Public Accounts Committee, the economic response to the coronavirus was, quote, rushed and reactive. That's despite it being identified as a top risk for years. The fight over the Chinese consulate in Houston shows that hardliners now have the upper hand in the Trump administration. President Trump has allowed a small group of advisors led by Secretary of State Mike Pompeo to push U.S. policy towards its most antagonistic in decades. U.S. officials say that China has a history of espionage and intellectual property theft. And President Trump mocked Joe Biden for holding virtual fundraisers from his basement, but the Democratic candidate is laughing all the way back to the bank. Biden's big donor committee took in more than $86 million in the second quarter. Meanwhile, the president took in less than a third of that from his high-dollar donors, just $27 million. He had declined to appear on live stream events. He held his first one Tuesday. Tom, Francine.
Thank you so much, Ritika. Now, coming up later today, we continue our conversation on airlines and transport with the Union Pacific chairman and chief executive officer. That's 11 a.m. in New York, that's 4 p.m. in London, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Bloomberg Surveillance, a stream of stories out for Francine Lacroix and Tom Keene in London, in New York. One we've really avoided so far, but really front and center in Washington, is the desperation of the Republican Party to get some coalesced idea of the next stimulus and to do it fast. Emily Wilkins is in charge of hand-to-hand combat for Bloomberg Government Congressional Affairs in Washington. Emily, it's an extraordinary moment for the GOP. Is this about the stimulus or is this about the future of the party?
Probably both. I mean, everything's kind of about the future of the party to some degree, isn't it? But Republicans are in the process of getting their bill ready to come together. They're going to bring out their bill. Democrats passed their bill in May. The two of them are going to try and come together and negotiate for another package to help Americans.
Is it just simply they're having their moment? The deficit hawks are hysterical about the size of the debt, and there's other segments of the Republican Party. And is it just understood they're having their moment here the third week of July, and then in 5 or 6 days, the story changes?
I think to a certain degree, there are people in the Republican Party who are not particularly happy about doing another round of stimulus. If you remember, initially Republicans said, hey, we're going to wait a little bit. We're going to see how the economy does. But look, we've waited. We've seen how the economy does. Things are still really rough. Republicans, they're under pressure from business leaders. They're under pressure from Fed Chair Jerome Powell. They're under pressure from voters to move here, to get something done, and to release more money into the economy.
Emily, what kind of stimulus will the U.S. actually get?
So it'll be interesting to see exactly what comes out of these negotiations, but we do have a couple details that we have from what Republicans are going to come forward with. They're going to propose $100 billion for schools, some of them to reopen. They're going to have another round of stimulus checks for certain Americans, $25 billion to expand virus testing. One thing we're not hearing about at this time is a payroll tax cut. That's something that the White House has been pushing, but it hasn't really gotten a very enthusiastic reception on Capitol Hill.
I mean, is there a sense of urgency in Washington of getting this done, or is it, politics above all?
I definitely think there is a sense of urgency. I mean, if you remember a couple of months ago, Fed Chair Jerome Powell came and sat down and told Republicans and Democrats, hey, if we don't get something done now, the economy is going to be in a much, much worse place. And I think you're starting to really see that. I mean, think of some of the states where we're seeing an increase in coronavirus cases, where it's becoming harder and harder to reopen. A lot of those are Republican states. And you're seeing Republican governors reach out and say, hey, we're going to be having issues with our budget. We need the federal government to act, and to act now.
Emily, through your reporting, there was, of course, big news about the China consulate in Houston. Are people worried about the economy worsening because of trade relations with China? And does that give them the extra impetus to get this through, to get a stimulus, as soon as possible?
If you look at the Senate, a lot of the bills that they've been passing are quite critical of China. They've passed a number of sanctions and bans on officials, on banks. They have come down pretty hard on China as far as how they've treated the Uyghur population, on the law that they recently passed in regards to Hong Kong. So this is something where senators have not shied away, and senators and House members have not shied away at all from sort of holding China's feet to the fire on some of the things that they've done that the U.S. does not see to be in good faith.
Emily, thank you so much as always. Emily Wilkins there, Bloomberg government congressional reporter. Now, up next, we speak about COVID-19 and the fight, the viruses, and the treatments with Jason Farley, Johns Hopkins professor of nursing. That's coming up shortly, and this is Bloomberg.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg Business Flash. Microsoft comes up short. The company failed to meet lofty expectations for 49% growth in its Azure cloud computing business. Still, Microsoft's overall sales beat estimates. Demand for subscription software remains strong. Investors have been bidding up tech stocks, hoping the pandemic would benefit for their business. SoftBank approached Apple to see if it would be interested in bidding for chip design firm ARM. Bloomberg's learned the two had discussions, but Apple isn't planning to pursue a bid. ARM is seen as a poor fit with Apple's hardware-focused business model. And Roche says sales took a hit from the pandemic in the second quarter. Still, the Swiss drug maker says they're recovering, and it's confirming its outlook for the year. Roche rolled out some of the earliest and most accurate tests for the coronavirus. And that's your Bloomberg Business Flash, Francine.
Ritika, thanks so much. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now is Johns Hopkins University Professor of Nursing and Infectious Disease, a trained nurse. He is Jason Farley. Jason, great to speak to you. This week we had a lot of trials for vaccines. Does it mean that we will eventually get a vaccine, or could the antibodies just not be sustained?
Yeah, well, good morning. We're certainly hopeful with the news out of Oxford. Yet another vaccine that is showing the production of antibodies. This study had over 1,000 participants. 2 doses seemed to do better than a single dose in producing antibodies. The investigators report similar to that of people who've recovered from the virus, so that's another good sign. So we now have a couple of vaccine candidates that are showing us similar results. Those results that they do produce antibodies after 1 or 2 doses, and that's a good thing. So it's all promising. But again, they are in healthy volunteers. That's a far leap from preventing coronavirus infection.
Jason, are we better at treating the sick with COVID-19? Is there a better chance of survival now than there was 2 months ago?
So the answer is somewhat it depends. Yes, we know a couple of drug candidates both reduce time in length of stay and symptoms. That's the remdesivir medication. We know that for oxygenated and mechanically ventilated patients, we have improvements with the drug dexamethasone. So that's another improvement, but those are modest types of improvements. And we've recently seen details about inhaled medications, inhaled interferon, potentially helping to reduce patients. Now that last study, I'm not being more specific because it's not peer reviewed yet. It is also very small sample size, and so the jury is still out on whether or not we can trust those findings in that study for the inhaled interferon medication. But we are seeing small gains in a variety of different therapeutic options, which help to improve overall survival.
Jason, when you look at some of the numbers out there and have we been able to treat, are you expecting a strong second wave as we get onto the colder months? And would this be tied also to people starting to travel again because of summer, but also schools reopening?
Yeah, so I think it's really important for us to realize that in the United States, at least, I'm not convinced epidemiologically that we've ever left the first wave. So do I see even a worsening of this first wave? I think the case is true. You know, in the beginning of the pandemic, we were all having conversations about, the summer will result in decreased numbers of cases, right? And most of us in our fields were saying, well, there's nothing specifically about summer that reduces virus. It's about our behavior. Well, our behaviors haven't really shifted that much. And so if we look at things that put our behavior in greater contact going into the fall, such as schools reopening, such as going back to work, such as reduced social distancing measures like restaurants reopening, all of those are opportunities to continue to spread and increase new cases of the virus. So it's really centered on how we respond behaviorally.
But children, as far as we understand, are actually less affected by COVID-19. Does it mean that they also transmit it less?
So no, and there's continued emerging data that our age of new cases are shifting into younger people, particularly those adolescents into young adults, and we are seeing some severe cases among that age group. So we can't, I want to make sure everyone recognizes that there's no such thing as a safe age in terms of COVID-19. But further, when we think about putting kids back in schools, we really need to think about, is that our best decision? Of course, there's economic impacts of not doing so. There's parental stress and family stress by not doing so. But schools are not designed to help provide social distancing. They're not designed to help kids who touch everything, including themselves and their face and each other, to prevent doing so. So we really need to think long and hard about best practices that other countries have implemented who have sent their children back to school and done so successfully. But we also really need to be thinking about how parents are engaged and involved in making this decision. Parents really need to understand what their school system is doing.
Jason, thank you so much. I mean, I know that the best piece of advice we got here in the UK is go and speak to your headmaster, to your principal in the school to understand exactly how the kids would go safely back to school. Jason Farley of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, a piece of news that we had over the last 30 minutes, the Italian 10-year bond yield actually dropping to 1% for the first time since lockdown. This is partly the recovery fund. This is partly the details on how much Italy will actually spend to try and get this economy out of the crisis. Coming up, more Bloomberg surveillance simulcasted on Bloomberg Radio.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
As COVID-19 halted the economy, retail investors turned to stocks, looking to gain on the market swings. We'll explore this trend on a Bloomberg special report, Markets Melt Up, this weekend on Bloomberg Television.
Fiscal stimulus is great, and it kind of gives us that shot in the arm and it buys us time to get there.
The next part of the V may flatten out a bit, because then you reach some social and psychological issues about people's confidence, and that, I think, will take some time to recover.
We talk about a correction. At this point, we're talking about a normal amount of turbulence in the equity market, which would be about a 10% correction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning, good morning. This
It's Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene, the opening bids from the Republican Party on the fiscal front. That is the focus down in Washington, D.C.
I called it, John Ferro, hand-to-hand combat, and it's not only this or that Republican, it's 3 or 4 flavors of Republicans. The Republican that really matters is the President of the United States, and John, it's simple. He wants to get this thing done now.
And he was asked specifically about some of the details at a news conference yesterday evening, Tom. He took a sidestep. He's leading this one to Secretary Mnuchin. I think it's amazing that we've got a real fiscal test, and yet this equity market, Tom Keene, still doing okay. Futures this morning up 11.
It's absolutely fascinating tape. We're now going to launch into a 1-hour data check. John, at some point with Lisa's going to talk Italy, Spain, or whatever. I don't know. Equity's up. John, look where the VIX is. 24.05. Crisis over.
Got to talk about the data too, Lisa. 90 minutes away. Initial jobless claims.
Yeah, this is going to be a really key to see the deceleration in job growth or potentially even decline. And this really is the backstop to what's going on in Washington, D.C. That's 8:30 a.m. U.S. initial jobless claims. And at 11 a.m., the other backdrop here is the widening deficit in the United States. The U.S. Treasury is set to announce their planned sales of debt next week. Look for another record amount. And then later today, Major League Baseball is kicking off what's set to be its shortest season since 1878. Breaking news, the New York Yankees versus the Washington Nationals with cardboard cutout fans and no crowd noise.
I'm saying it's great news, Tom, because it's the shortest season since 1878.
Ooh, that's harsh.
That's the best part of this for me. Can they keep it this way?
We're looking at this with baseball, folks, and for those of you worldwide with the National Hockey League, John, can we have a moment of silence for the Premier League that absolutely nailed this?
That was your moment of silence. That was it. That was it. I think they've done a decent job. I agree with you, Tom.
Yeah. I mean, they've done well. Liverpool, that celebration last night, I believe they won, and there'll be a tot celebration here, in a bit.
I'm going to get the price action, Tom, and move on to the markets.
Let's do that.
If you don't mind. Equity futures are positive, up 1/3% on the S&P 500. Here's the story for me. Euro dollar breaking out. It got a peak of life through 116, liked what it saw. It's approaching that level once again. The dollar breaking down. That's the story in the FX market. Dollar weakness in the bond market. Just take a look at the Italian 10-year, a break of 1%. Tom, what is important here, if you believe in the fiscal backstop in Europe, then Italy should start trading more and more like a sovereign. And the spread over Spain doesn't make sense if that's your argument. So that's the spread to watch. Italy over Spain. To what degree can that spread close in the coming weeks and months?
And John, I know you like math on Thursday. If you take a log y-axis on that Italian piece, you get a curved line. That's called log convexity, and that means there's an acceleration to that move as a sovereign credit.
Some big moves in the last couple of weeks. Let's start the conversation this morning with Sebastian Page, T. Rowe Price head of Global Multi-Asset. Sebastian, fantastic to catch up with you, sir. So many people come on programs like this and talk about an expensive stock market. Can you talk to us about an expensive bond market, please?
Right. Stocks look expensive for sure, right? We're up 40% from the bottom, and we're looking at minus 44% year over year in earnings. But bonds, to me, especially treasuries and safe bonds in general, look even more expensive. If I go on my Bloomberg and I look at the real yield for the 10-year U.S. treasuries, I get minus 88 basis points. If I invest in safe bonds in the U.S. right now, and I hold, I'm going to lose money. So we end up neutral between stocks and bonds, and we don't think stocks are in the bubble necessarily.
Anytime we say the real yield, we have to defer the next question to John Ferro. John, pick it up on the real yield.
Is that how it works? Is everything pricing, Sebastian, then off that deeply negative real yield in America?
Generally speaking, when the discount rates come down, all else being equal, and that's a big all else being equal, valuations come up. So whether you look at nominal or real yield, depending on how inflation expectations changes, you can, in theory, justify higher valuations. And that explains part of the rallying stock.
Part of it. But, Sebastian, this is so important. George Saravelis was with us, and he alluded to a Peter Hooper Deutsche Bank essay this morning that showed that if we get into this compression of yields, we may get a massive need for stimulus. The calculations of Deutsche Bank for stimulus are extraordinary. Sebastian, do you just see that out there, that we run out of options in bonds, and we've got to go to ever greater fiscal stimulus?
I think that's correct. I mean, one of the highest estimates I've seen for the global stimulus measures between fiscal, monetary, all over the world is 24 trillion if you include some potential measures. So think about that, Tom. 24 trillion. The size of the stock market globally is 50 trillion. So we're talking about stimulus measures that represent half the total market cap of the global stock market. We're getting more money relative to stuff to buy than ever before, and we're getting it 3 times faster than ever before.
Sebastian, I'm buying your cause here, and I'm saying, okay, stocks perhaps look better than bonds. So why are you selling stocks right now?
So we benefited from the recovery, and there are risks to this rally. So to be clear, we're neutral. We think just now's not the time to be a hero, if you will. Some of the key risks are what you're talking about on your channel this morning, the political uncertainty, the stimulus and relative to fiscal in the U.S. and the deadline we're heading towards, it looks like a cliff. We need $1 trillion to be confirmed ASAP. Then you have the election. And then I think the number one risk, of course, is the course of the pandemic. We have learned that this is not a one-way process. The recovery from the pandemic is not a one-way process. So there are risks. Sentiment remains fairly low. Believe it or not, this has been kind of a paranoid rally, right? If investors were so bullish and stocks were in such a bubble, why would value stocks, the cyclical stocks, this is something I know you talk a lot about on your show, why would the cyclical stocks be down 30% year to date relative to growth stocks if investors were so bullish? If you look at sentiment indicators, whether it's positioning or surveys, they have improved, but they're still in the bottom quartile of their history. So a lot of this uncertainty is priced in.
So, Sebastian, what would make you deploy some of your cash into stocks right now?
We do have some dry powder, and we're looking at, really, it comes down to the course of the pandemic in the U.S., and we're looking at improvements in the political situation and just better valuations as well. If we were to get a pullback, that would give us an opportunity to add back to stocks, depending on the reason for the pullback, of course. Now, I should say, by the way, we do have some cyclicality under the hood. We're neutral stocks versus bonds, but we're actually long some of the asset classes that do well in the recovery historically and that haven't done well yet. So we're talking an overweight small cap stocks, an overweight credit, emerging markets. So we prefer to take cyclicality where relative valuations are attractive under the hood of a neutral stocks versus bonds position. That's how we're playing this market.
I look at this, Sebastian, is cash is an asset. And what it really comes down to here is you're telling me equities fully priced, bonds fully priced. At T. Rowe Price, is cash a legitimate asset?
It's an asset when you want to have short-term dry powder, when you want to have liquidity in your portfolio. A lot of our investors are very long-term investors, and they maintain minimal amounts of cash just for frictional issues. But we've learned in this recent sell-off that having dry powder when things get really, really bad and you don't want to have to sell credit, that it helps to have cash on hand to buy stocks when in a market sell-off, which is what we tend to do.
So, Seb, what do you make of this quote from Matt Hornback over Morgan Stanley, who says, however, over time, cash becomes risky itself as opportunity costs mount and performance lags against benchmarks. Not everyone enjoyed the best 4-month performance for the S&P since 1938. Seb, there's some people that believe if you stick in cash, that's a risk. There's some career risk there for some people. What do you say back to that?
Completely agree. And I'm talking about a diversified portfolio where you add, say, 5% to cash to have dry powder on hand. I don't think in this market, now is not the time to be a hero. Investors should not go all the way to cash. Ultimately, if your time horizon is relatively long, in our tactical asset allocation committee, we look at 6 to 18 months. Stay diversified, stay invested. I agree, Jonathan, with that statement.
Seb, fantastic to catch up with you. Got to get you back on the program soon. Sebastian Page there of T. Rowe Price. Looking ahead, Tom Keene, 1 hour, 20 minutes away. Initial jobless claims, 1.3 million is the estimate, and that's a problem. We're stalling out.
And I can honestly say, John, 6 days ago when we last looked at it, I never would have thought I'd say this week is ever more important. Between the stimulus, between, like we just heard from Twitter, and we see the ad shortfall at Twitter, which goes across all of ad media, Coca-Cola with the revenues down 28%. I mean, the jobless claims number is maybe the most important single statistic in America.
And the conversation, Tom, around enhanced unemployment benefits is so flawed. We'll talk about this with Kevin Cirilli in a moment. The idea that it disincentivizes a return to work, I understand the concept, and arguably that might happen in the future, but in the here and now, there is very little evidence of it in the aggregate data. If you believe that, then answer this question. Explain the last payrolls report.
Well,
why was wages down? Wages were down because the low-wage segment of the labor market came back to work. Right. There's no evidence there at all.
The big issue on this, John, the big issue on $600 a week or $125 a week, whatever the numbers are, is the variance across this nation is huge. It is ginormous, John, the difference between living expenses in New York City versus name another geography.
No, but Tom, I'd go one step further. I think there's a political argument the Republicans are trying to push. And maybe you accept it, maybe you don't. Their message, I think they could make it clearer. We think you should be paid more to be in work than out of work. If that's the argument, make the argument. But if you're going to go out there and say it's stopping people returning to work, that might be true in the future. With unemployment where it is right now, Tom, with the amount of people out of a job and the amount of jobs available, I'm not sure the data's there to back that argument up.
You know, I agree strongly the data here is suspect. The modeling I'm seeing, John, is to 21% unemployment.
The conversation continues. We'll touch base with Kevin Cirilli down in Washington, D.C. in just a moment. Coming up shortly on this program, Ralph Schlossstein, Evercore co-chairman and co-CEO. From New York this morning, good morning. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. China may retaliate for the closing of its consulate in Houston by targeting the U.S. consulate in Hong Kong. That's according to the editor of the Chinese Communist Party newspaper Global Times. He writes that the U.S. has over 1,000 staffers there, and that means it's obviously a spy center. The editor's comments have frequently been a tip-off to what the government does. President Trump is now expanding a federal law enforcement operation to Chicago and Albuquerque, New Mexico. That sets up a showdown with state and local Democratic leaders who've denounced the presence of federal agents in Portland, Oregon. The president says his goal is combating violent crime. The move is seen as an appeal to his conservative base. British Prime Minister Boris Johnson is trying to head off growing support for Scottish independence. He'll stress the value of the United Kingdom in a visit to Scotland today. Tensions have been growing between the governments in London and Edinburgh. Issues include the coronavirus pandemic and calls by the Scottish National Party to hold another independence referendum. And Tesla is possibly paving the way for its soaring stock to join the S&P 500 index. The electric car maker reported positive earnings for the fourth quarter in a row. Still, that's not good enough for CEO Elon Musk. He thinks Tesla isn't growing fast enough. Shares have quadrupled since March. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff, and it will take you in interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
You see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The Nissan Ariya is the one that represents for the Nissan New Chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
We are setting out clear expectations for how the Chinese Communist Party is going to behave. And when they don't, we're going to take actions that protect the American people.
Mike Pompeo, he is not holding back, coming out swinging towards the Chinese Communist Party through much of 2020. From New York City this morning, good morning to all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your price action, 2 hours and around about 12 minutes away from the opening bell in New York. Equity futures, we're up for a fourth day on the S&P 500 coming into Thursday. Can we make it a fifth? We're up 13. We add some weight to the S&P 500. Your 10-year yield, 0.6%, but story of the last week or so. Euro dollar showing some ambition. Euro dollar 115.88, up 0.16% on the session, but it just speaks to the breakdown in the US dollar more broadly, Tom, over the last couple of days.
Well, the breakdown of the dollar is tangible on the blended index DXY, which is more of a major trading partner index. There's no question it's breaking down. But I looked carefully this morning, John, at the trade-weighted Deutsche Bank index for the dollar, and it's range-bound. Yes, it's come down abruptly, but it still hasn't broken through to the point of, say, David Bloom at HSBC. Right now in Washington, and this could be a 2-hour conversation today with Mr. Cirilli, our chief Washington correspondent, just because we heard from the Secretary of State, Kevin, let me talk about China right now. What is the risk that the U.S. overreaches here?
I'm not sure that any Republicans or Democrats see much of an over-risk. I think that they view this as a reset of U.S.-China relations. I think that what I hear from conversations here in Washington is the risk for Xi Jinping, quite frankly, especially as Xi Jinping is going to be facing some economic pressure in China. So I think from a broader, longer-term strategy, Tom, it's really about developing in emerging markets, whether it's the U.S.-India relationship or even to some extent even U.S. and Africa. And I think that's where the Mark Warners of the world, a Democrat from Virginia, previously working in telecommunications, I think that's where you're going to see a lot of the conversation move in the short and long term.
Kevin, 23 on the calendar, the urgency here on stimulus, is it properly understood in Washington, the timeline here of 23, 27, July 31, and then those first few days of August when the rent's due?
You know, I was speaking to some staffers yesterday, to some Democrats, and they really feel that they have momentum on their side in terms of garnering the support of the American people to get the stimulus across the finish line, especially as it relates to unemployment benefits. When I talk to Republicans, there's really two camps, and I think that even the Heritage Foundation camp is somewhat lenient about providing economic stimulus and relief to people right now who desperately need it. But they also want to make sure that for individuals who are able to go back to work, to keep their jobs, that they be able to have an incentive to do so and that companies not be left on the hook should they be wanting to provide those types of jobs for their workers.
Kevin, the team down in Washington at Bloomberg, which you are, of course, a part of, reporting that maybe we get a short-term extension. That's what the administration is looking for. What are you hearing?
That is likely going to be, I think, all of the conversation dominating in the next 12 hours here in Washington. There were some significant breakthroughs made last evening in terms of a short-term extension. It is and yesterday I made the comparison to there being like a government shutdown, a lot of drama, but then ultimately some type of breakthrough. This is straight out of the government shutdown playbook, Jonathan. It's kicking the can down the road and setting up another, I don't want to call it a fiscal cliff, but setting up another cliff, so to speak, for lawmakers to get some urgency to get behind.
And Kevin, this additional cliff comes along with a handful of stimulus bills. This coming from Senate Majority Leader Mitch McConnell. What's the thinking behind a handful of bills rather than one large one to counter the Democrats' $3.5 trillion proposal?
Lisa, this is Leader McConnell's playbook. Get a bunch of bills in one ball and shove them through and try to get it over the finish line and steamroll it all the way home. And so by lumping things like liability protections, by lumping things like tax credits, mind you, for companies that are going to have to be weighing whether or not to have layoffs by the end of the year, he feels that he can get Democrats and President Trump to the negotiation table to move it even with more speed and urgency.
Kevin, I wonder if this is actually sensible policy. We knew last time that the huge divide between the Democrats and Republicans could have been addressed pretty quickly if they stripped some elements out of the package and put it to one side. Do you think doing a series of bills actually makes things just a little bit more efficient to get things passed that we agree on now and carry on negotiating on the things that we don't?
Yes. However, if you got one lawmaker, whether it's a far right or a far left individual holding up the calendar and holding up the clock on the floor, that's where the piecemeal approach runs into significant problems.
Kevin, one final question. What are you going to look for today on the Hill? I mean, we're all wrapped up in the back and forth, and as I said earlier, the hand-to-hand combat. You're actually going to go up there. What are you going to look for?
I'm really interested in the payroll tax cut because I do think that it is separate, Tom, from this broader piece of economic stimulus. However, I do think that it's a longer-term strategy that goes beyond the short term, beyond the urgency for economic relief, because it speaks directly to the middle class, and it's a debate that many Republicans have wanted to have for years. Why? I'm just seeing how they sell that, Jonathan.
I get it. I just don't understand it. This is a non-starter. I don't know a single Republican that has said they endorse it. The only person I've heard say we should do it is Larry Kudlow.
Because President Trump...
Order place to sell short euro at 115.877. So I'm placing an order to sell short at 115.877.
For many Republicans, including senior Republicans like John Thune.
Kevin, great to catch up with you.
Busy
day ahead, I'm sure. Busy couple of weeks, too, down in Washington. Kevin's a really chief Washington correspondent for Bloomberg. Tom, this is a non-starter. The Democrats aren't going for it. The Republicans aren't going for it. I'm trying to understand why the administration is pushing for it. They still haven't said it's a red line because I think they know it's going to be really difficult to achieve.
A lot of this is out of Michigan. Michigan is the academic house, John, that's really looked at this. And here's the summary. The most efficacious way to do this is to put a check in the mail. And that's all there is to it. And there's some issues there where people say that they don't spend it. But there's been a lot of study of this, and you're correct, John. No one out there talks up payroll tax cut.
The other issue as well, Tom, is that once you give something to someone, you can't take it back. That's the struggle they're having down in Washington right now. They could have done something much more complex. They could have said, this is what we'll do with unemployment insurance. We'll cap it at a certain amount. We'll say it has to be a certain percentage of your previous paycheck, and we'll go forward with that. It was too complex to process it that way. That's why they did it this way.
We are all living our experiences. What I see out there, John, is small business flat on its back. That's what I see. I mean, the urgency of this, I can't calculate.
I agree with you, Tom. Conversation's got to continue. Coming up on the program, Ralph Schlossstein, Evercore CEO and co-chairman. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro, on course for a fifth day of gains in this equity market. Get up the board. The market screen as follows on the S&P 500. We are positive 9 points and up a third of 1%. In the bond market, unchanged on a 10-year at 0.6%. We've talked about that dollar weakness over the last week or so. In foreign exchange in G10 right now, the dollar doing okay. It's mixed in G10, but the euro breakout has been the story for many. Euro dollar through 116 just briefly. We got that 116 print in yesterday's session. We're at 115.83 right now, Tom Keene, up a tenth of 1%.
On euro yen, stronger euro versus the yen. I'm watching euro Swissy, which has been very, very tight in range bound as well. Some real nuances out there right now. Right now joining us, and I'm really looking forward to a good conversation with a guy who has put together a firm of continued success. It is Evercore. It is Evercore ISI, of course, with the great Ed Hyman. And he is Ralph Schlosstein. He is co-chairman and co-CEO, looking like he just played a folk act at the Denison College Michael Eisner Performing Center. And we are thrilled he could join us this morning. Ralph, I want to talk first about your senior chairman, Roger Altman. I think it is underappreciated how lonely you guys were when you set up Evercore. What did Altman and Schlosstein do at that time that was so different?
Well, I wasn't there. Roger was there for the first 14 years without me. I joined 11 years ago. But he literally came back from his stint at the Treasury and thought that the world needed a more old-time investment bank, one that focused purely on advice. And the very first presentation he made 25 years ago, the first page had the words quality and integrity on that first page. And I've been here 11 years. The one thing I was allowed to do by Roger is I changed quality to excellence. And so now it's excellence and integrity. But it's a great business model. We have very senior people. They actually do the work rather than just show up at the pitch and the board meeting. So
well, that's a huge distinction, and certainly we've seen that with Ed Hyman and with the others of your principals. Okay, let's cut to the chase. How do you readjust and recalibrate out of this pandemic, given the competition of the major banks?
Well, what we have done over the last several years is to dramatically broaden the things that we can advise our clients on. So we have the #1 activist defense practice. We're the only independent firm with an equity underwriting capability. And in the quarter we just finished, we did more underwriting revenues than we did all of last year, which was a record for us. We have debt advisory, we have restructuring, advice on hedging. So what we've done is we've built deep capabilities in everything that a company would want to do with a big firm as a counterpart.
Okay, Ralph, one important question, and this has come up with Lisa Bramwitz and John Farrow day after day. You guys have been massively benefited by the stimulus of Jerome Powell and by the leadership of Congress. How do you move forward with the American public where we see with New York Wall Street and indeed global Wall Street benefiting so much from the stimulus?
That's I think, a really, really important issue. There's clearly been a massive effect on the capital markets, both the equity market and the debt market, and that has certainly benefited the trading activities and the shares of the large firms and of all firms also. So we have this massive inequality. It was necessary to stabilize the economy, but it's had a much greater effect on the wealth of the wealthy than it has on the well-being of those in need.
Does that compromise your ambitions in any way, shape or form, Ralph?
No, I think we have to continue to do what we do, but it does, in my private life, make me supportive of people and of policies that are focused more on a more equal distribution of wealth in this country.
Give us more detail on that, Ralph. Is that a shift to the left for you, politically speaking, ahead of this election?
No, I actually worked for Hubert Humphrey in the Senate and then worked for President Carter in the White House. So I've always had I wouldn't call it a left. I'm a conservative on fiscal policy, but I do believe that we need to do more for those who are underserved in terms of income, healthcare, housing in this country.
So, Ralph, given the fact that you're a fiscal conservative, what would you say to companies right now raising record amounts of debt in order to survive this period of time, becoming more indebted ahead of a period of slowing growth?
Well, I think the most important thing for every company to look at in the period that we've just been through has been liquidity. Do we have the cash to survive? Because in 08 and 09, we learned that financial institutions fail not because of capital, but because of liquidity. And in this recession, deep recession, we have learned also that that phenomena is more widespread. So we spent a lot of time in the last 4 months encouraging companies to put more cash on their balance sheets.
But here's the conundrum, Ralph, because we're heading into a period of slowing growth. We have a more fragile economy, and we have more indebted companies. Why not just file for bankruptcy? Why not renegotiate the debt loads now with creditors to reduce the obligations rather than putting their entire capital models in a more precarious situation?
Well, there is some of that going on as well. I think the real issue in terms of how to solve one's balance sheet issues depends upon the outlook for the business. If it truly is a V type downturn and then recovery, then it's just a matter of having the cash to survive to the other side of the chasm. Other businesses obviously are going to be more seriously and permanently impaired, and for them, bankruptcy and recapitalization is the right model.
Ralph, the heritage of Evercore Forward is on John Weinberg and you. And of course, Mr. Weinberg, that name is magical and always associated with Goldman Sachs. I'd be honored if you'd comment, Ralph, on the retail experiment at Goldman Sachs. Can institutions be all things to all people?
Do you really want me to comment on that?
He'd love you to.
If I were in their shoes, it's not the path that I would choose. I think there are two parts of their retail experiment. One is collecting deposits. That makes sense because deposits are a much more stable funding source than going to the institutional market. And I think that is a very sound thing to do. And they're paying up a little bit, but they're paying for much more stable liabilities or borrowings. The lending side of it, I'm not a big fan of. It's a very crowded business and coming late to the party, in my view.
As you know, Ralph, Bloomberg Surveillance is all about the conversation with experts. Of course, we all know your acquisition of Ed Hyman's services a number of years ago. Tell us the value, the intellectual component value of the future Wall Street, the future global Wall Street. How much does it matter that experts will be needed?
It's interesting. I often say that we're in every business that Goldman Sachs is in that meets the following criteria. You compete solely on the basis of your ideas, your intellectual capital, and your relationships, and the only source of revenue is fee income. So we are the walking example of an intellectual capital firm. We have two major businesses, the research business, which you just asked about, and the investment banking advisory business. And both of those are fundamentally driven by intellectual capital.
Ralph, one final question. This is of critical importance. We have a viewer that emails in right now, John from Coventry, and he suggests I ask you, do you think I could pull off the beard, Ralph? I mean, this was a point of debate pre-pandemic. Did you think, does my face say beard?
Tom, you're asking about you?
Yeah, do you think I should grow a beard? What do you think?
I don't know. You should probably ask those near and dear to you.
Yeah, I did. Al from New Jersey said no. Ralph Schlosstein, go away. Congratulations.
Well
Thank you.
Congratulations, Ralph Schlosstein with Evercore.
All right.
I thought it looked good,
care, Tom. Great talking to you.
Thank you, Ralph. Appreciate it. Tom, I thought it looked good. I remember saying to Lloyd Blankfein at Goldman, thank you. Yeah. Thank you for making stubble okay. In 2020, we've got to make that shift here in America, Tom. It's normal in Europe. I don't know why it's still a thing here in the States.
Don't get me started. You had me going yesterday on the new governor of the Federal Reserve System.
Judy Shelton and beards. They're the buttons that I can push. Beards and Judy Shelton.
Yeah, that's, it's a daily button with John Farrow.
He's happy with the tots at the moment.
Oh, there you go.
That is not the third button anymore. Tom, we've got to talk about this market. Equity futures down, up rather, by about 10 points on the S&P 500. This breakdown in the US dollar and the breakout in gold, it's all coming together with a lower, more negative real yield in America.
Absolutely. Folks, this is a lot of fancy theory, but all you got to know is it's a surreal moment, and the markets are starting to react to it. And John, I go back to the blunt interest of aggregate demand, just the demand out there, the economy out there. I see the revenue deltas we're seeing in the airlines, Coca-Cola and such, and it just leads to lower for longer.
Big winners, big losers, and low rates for a whole lot longer. Coming up on this program, we have got to talk about China. The next move coming out of China after the United States orders the shutdown of a consulate in Houston. Up next, Meredith Sumter of Eurasia Group, the head of research strategy from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. With equity futures out after a 4-day winning streak on the S&P 500, we break out by another 10 points, adding some weight to the benchmark, up by around about 1/3 of 1% on this Thursday morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The world has now gone over 15 million coronavirus cases. The US, Brazil, and India account for nearly half of all infections. Texas reported 197 deaths, the most ever in one day. And in Florida, Governor Ron DeSantis...
I'm canceling order to sell short euro. It moved too far. Well, it didn't reach the level, yeah? Okay. So the order to sell short at 115.877 cancelled.
Rushed and reactive. That's despite it being identified as a top risk for years. The fight over the Chinese consulate in Houston shows that hardliners now have the upper hand in the Trump administration. President Trump has allowed a small group of advisors led by Secretary of State Mike Pompeo to push U.S. policy towards its most antagonistic in decades. U.S. officials say that China has a history of espionage and intellectual property theft. In an excerpt from a video released today, Joe Biden discusses the death of his son with President Obama. The Democratic presidential candidate recalled it in the context of protections provided by Obamacare.
Biden said he wondered what it would have been like in the middle of treatment to hear that insurance had run out. He said that could have happened before Obamacare. And the parent of Mercedes-Benz expects to make an operating profit this year. Second quarter results signaled that Daimler weathered the unprecedented industry slump better than expected. The company is counting on the economy improving and no second wave of the coronavirus. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I have enormous respect for the Chinese. I think they've built an incredible country, economy, but, like all of us, they're not perfect. And, I think the Trump administration has been, stronger with China than any other previous administration in many years. And I think that strength is, in certain cases, very important to be demonstrated.
Bill Ackman there of Pershing Square Capital, the founder and CEO on China. From New York, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tom, I think we're all sick to death of this rising US-China tensions. Tensions have been simmering for the best part of 2.5 years. Well, this administration confronting the Chinese Communist Party all the way back to 17, 18, where we really started to ramp up trade.
It's been a very careful ramp up, John, and to your credit, I would mention Mr. Farrell, folks, has been way out front on this. Right now, our conversation of the day on China. Meredith Sumter's Eurasia Group, head of research strategy and operations, and a move from Bill Ackman over to the authority of Meredith Sumter is important, out of LSE, and of course with a profound knowledge of China. Meredith, what can you add to the conversation? You see the punditry, it's in the zeitgeist right now, but what can you add on this Thursday morning about this consulate tit for tat?
Great to be here with you, Tom. I would say, look, this is a remarkably unusual escalation. A closure of a consulate outside of wartime is rare, and it's really just one of a myriad of U.S. actions, as you've noted, to pressure China and to try to put the bilateral relationship on a fundamentally different course. You know, we heard comments that this is strong, but the question is it effective? And what's key here, as you see this unswerving U.S. pressure in speeches of Trump administration officials over the past several weeks, National Security Advisor O'Brien hitting at the ideology of the CCP, the Communist Party, Attorney General Barr calling China's ambition isn't to trade with the U.S., but to raid the U.S., and of course, Secretary of State Pompeo, who's called the relationship fundamentally detrimental to the United States. All this tells you is that you should expect the U.S. to continue this escalation with China up through November, even as most U.S. officials recognize that President Trump, according to poll numbers, is currently on track to potentially lose in November. Their actions, bottom line, what we're watching here is their actions could fundamentally alter the course of the bilateral relationship on the eve of a potential administration change.
Well, Meredith, let me ask you this. From your perspective, are these decisions surgical or are they reactive and unpredictable?
You mean the decisions from the U.S. side, Jonathan?
Yeah, I'm just wondering if there is an ultimate objective here and there are some surgical decisions which are going to come together in a bigger picture, there's a bigger strategy, or whether this is just ad hoc.
I wouldn't call it necessarily ad hoc, but I wouldn't call it part of a grand strategy at all. Talking to Trump administration officials, what's clear is the president has given a green light for his officials to get tough on China, thinking it might help him in the polls, although so far his campaign has been disappointed by that, with voters focused more so on pandemic than on China. But President Trump has been very clear that his phase one trade deal is off limits. So you see this tit-for-tat escalation being pushed by the U.S. side that gets right up to that breaking point, but is not meant to go over the line. And the risk is that they could go over the line without knowing that they're doing so.
What happens then? What happens if the phase one trade deal gets rejected, is basically dead in the water, as Leland Miller of China Beige Book thinks it probably will be soon?
You know, Lisa, what's really key here is that, well, obviously, you know, in the immediate term, there's going to be negative market reaction and fallout. This is not what President Trump wants on his side. Neither is it what President Xi wants on Beijing's side, which is why we still have a 65% probability that that deal lasts through the November election. But what's really key here is that phase one deal is increasingly a less relevant barometer of the U.S.-China relationship. Even if that deal survives, the broader relationship has pretty much fallen apart. And that is going to be the case regardless of whether you have a second-term Trump administration or if you have a Joe Biden administration who will come into office and inherit quite a challenging bilateral relationship.
I mean, we can go all day on this and the different theories of game theory, Meredith Sumter, but it comes down to a game of chicken. Maybe you go back to Cuba and the Cuban Missile Crisis, mutual assured destruction. It comes down to who's going to blink first. How does that play out? What is the process of how you get through a game of chicken?
Well, I would say, I think that from Beijing's perspective, they're just trying to manage that game of chicken through November, looking at poll numbers and hoping that they're going to have a change in U.S. political leadership that they don't think will necessarily have a fundamentally different view of that sort of confrontation with China, but it'll be handled in a much different way, in a much more manageable way for Beijing.
Meredith, we've got to wrap up by talking about the response from Beijing. Last week, the United Kingdom is freezing out, announcing plans to freeze out Huawei. What we've learned in the last 24 hours is that China is responding by having a blackout for the English Premier League this coming weekend, the last game of the season. I'm just wondering why they keep going towards sports. They did this with the NBA in the last 12 months as well. They're doing it with English football now in the last 24 hours. How effective do you think this strategy actually is?
Well, Jonathan, talk about a game of chicken. You think you have problems with the U.S.-China relationship, and China has problems across a whole host of its relationships externally. And the question is, does Beijing realize the strategic error that they're making? In other words, at a time when the U.S. position vis-a-vis China and, frankly, vis-a-vis the rest of the world has been at odds with what the rest of the world wants, this could have been an opportunity for Beijing. But really, Beijing has fundamentally failed to capitalize on that, on the part of using politics and its own political incentives to try to coerce other countries in a way that's going to have negative spillovers.
John, are you telling me that China's going to black out Crystal Palace and the Tots?
That massive game that you're so excited about, Tom, they won't be able to see it.
That's un-American.
Meredith, we've got to say thank you. Meredith Sumter, Eurasia Group Head of Research Strategy and Operations. Tom, what Meredith is touching on, though, is absolutely vital. Whether the Chinese president, the leader of the Communist Party, is overreaching and has miscalculated, because Europe for a long time sat on the fence.
Right.
The United States has got more allies. The UK starting to go with them a little bit more, and more countries going to come with them as well.
I'm going to do a massive shout out right now to Elizabeth Economy at the Council on Foreign Relations, John. She was way out front on this idea of the fragility of this experiment by the leadership in China.
And Lisa, this narrative has been building for a while, that we break out into two spheres of influence, with the United States at the epicenter of one and China at the epicenter of another. I have no idea if that's ultimately where we end up, but the way things are lining up, that seems to be the direction of travel.
And it's interesting that the U.S. is gaining more support, even though it's unclear what the diplomatic outreach has been. I will say the focus of the economy centering a lot of people, the idea that certain things are off limits in order to preserve the economic recovery, John.
Should we get you into the price action as well this morning? Good morning to you all. We are around about 1 hour and 35 minutes away from the opening bout, with equity futures coming in, but still positive by about 8 or 9 points on the S&P 500, up 0.25%. Elsewhere in the bond market, 10-year Treasury is getting comfortable, down by 0.6%. We are really, really sticky down there, 0.5 and 9%. In the FX market, the euro approaching 116 and breaking that level in yesterday's session. Right now, 115.72. Pretty much flat, giving up the gains of the morning so far. And we are on course, potentially, for a fifth straight day of gains on the S&P 500, up 9 points on a day, up 1/3% on the session. Coming up next, a conversation on credit you do not want to miss. A good friend of this program, Lale Topcholu of JOHCM, joins us next on Bloomberg.
Said that the idea that China is our competition is really bizarre. Well, watch what happened. Not a good situation. Their freedom's been taken away, their rights have been taken away, and with it goes Hong Kong, in my opinion, because it will no longer be able to compete with free markets. A lot of people will be leaving Hong Kong, I suspect. And we're going to do a lot more business because of it, because we just lost one competitor. You'll see more coming. This was a very important bill that we signed, but you're going to see more coming over the next short period of time. But we can impose massive tariffs on China if we want, and other countries if we want. and we'll see. We just want to be treated fairly. Tremendous amounts of our energy to... No administration has been tougher on China than this administration. We imposed historic tariffs. We stood up to China's intellectual property theft at a level that nobody's ever come close. We confronted untrustworthy Chinese technology and telecom providers.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This was that crisis, and that's what we delivered with a 15+% ROE. So I think it validates the strategy, but it's our strategy. It's not for everybody. This is what we chose. We didn't want to be credit heavy. We want to be flow-based, fee-based, asset-based.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Fiscal stimulus is great, and it kind of gives us that shot in the arm, and it buys us time to get there.
The next part of the V may flatten out a bit, because then you reach some social and psychological issues about people's confidence, and that, I think, will take some time to recover.
We talk about a correction. At this point, we're talking about a normal amount of turbulence in the equity market, which would be about a 10% correction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An interesting Bloomberg Surveillance today on television, on radio. We welcome all of you worldwide across this nation, where the linkage, the urgency that we see within our politics and our economics is truly front and center. John, get out the calendar. I believe it's 23 July, and this is a nation staggering to the first week of August.
Hey, Tom, what urgency. It's sunshine and rainbows in the equity market. Down in Washington, D.C., we haven't seen the urgency I think that we actually need. There are a lot of people who are still out of work. This labor market speaks to a ton of pain, and it's not going to heal as quickly as we'd like it to. We've already started to see the data stall, and at 8:30 Eastern time, in about 30 minutes, initial jobless claims set to come in at around 1.3 million again, Tom. We need to see much bigger improvements.
With some nuance there, folks, and that'll be a key statistic of the week. Lisa Abramowitz, rule number one in the equity market is follow bonds, and I just still continue to see a yield compression, lower yields and flatter curves.
Yeah, sunshine and rainbow is very much funded by a negative real yield that is actually the most negative in the United States since 2012, with the 10-year Treasury real yield, as you and John were talking about earlier, at negative 0.92% yesterday. Look, Tom, there is a question how long this compression can go on. Greg Peters yesterday was talking about how it can go on for a lot longer. And you know what? Junk bond yields poised to hit a new record low within the next month.
Well, I'm thrilled you bring that up. Greg Peters with us, of course, Morningstar Fixed Income Manager of the Year a few years ago with PGIM, and that's a buy side, that's a portfolio management feel, maybe a longer term institutional money feel. John, let me look at the data here. Futures up 9, not quite with the optimism they were an hour or so ago, but the VIX 23.96 says it all. And just one more statistic, 1873 on gold, a real run on gold where you begin to look, folks, at 2000 an ounce. As Lisa mentions the real yield, of course, the acclaim, the anticipation of the real yield coming back. And John Farrell, that is a reason for you to bring in our next guest here, who looks not only at the nominal yield, but always at the real yield.
Thank you for the honor, Tom. I appreciate that. Lale Topcholo joining us now, JOHCM Senior Fund Manager. Lale, fantastic to catch up with you. Good friend of the show, and it's been a while. The pain trade in Europe for quite a while was an ECB that was all going, guns blazing, and yields and spreads just came tighter, 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 even though the economy didn't improve that much. Are we seeing the same dynamic play out here stateside?
Good morning, all. I mean, you certainly are, right? I think you sort of set it up well. Look at the negative yielding assets. It's on the growth again. We're steadily rising, and the income grab is desperate. Look at the dividend yielding stocks. Look at high yield, as you just highlighted, and EM. People are chasing now assets that have lagged, which is a very dangerous game to play. One last thing that I'll leave you with is you highlighted the central banks. Look, ECB and Bank of England has been buying corporate buying since 2016. That did not prevent spreads blowing out in March. So markets, you have to respect what the market is telling you, but it doesn't mean you can't disagree with it.
Lale, I've been dying to ask you this question, which is simple. What is your guesstimate of what issuance does here forward? This market is so odd. Some would say artificial. How do CEOs, how do CFOs, for that matter, how do government officials react?
It's certainly artificial when you have an indiscriminate price, price indiscriminate buyer, which are the central banks. They will buy regardless of what's happening. There's no fundamental analysis being done. If you're a company, you have two things to deal with. One is your liquidity. Liquidity is paramount. And I think everybody is right now focused on that. And the most common question I get is, will this company go bankrupt in the next year? That's not always the right question to ask. It's one of the questions to ask, but it's not always the right question to ask. Because especially as you get to the leverage universe, and that's where it gets tricky, they will issue to basically plug in the gap that's being caused by the crisis. But you have to be able to see the light at the end of the tunnel. Otherwise, you're bridging to nowhere, and the second leg of that phase is going to be distressed exchanges, which in the land of no covenants, that's where the capital impairments will come.
So, Lale, when do we cross into that bridge to nowhere? When do we move into a time when actually fundamentals matter, even though you do have a price-insensitive buyer in the Fed, in the ECB, in the BOJ?
It will take time. I think right now, if you look at the 2Q earnings, which we're now going through, the numbers are coming better than expected. But again, I think the companies are hoping that this is a temporary blip. So they're tight. They're managing their working capital very tightly. They're all talking about cost cuts and reduced expenditures. Now, remember, the other side of that is you reduce expenditures. It's the lost income for somebody else. So maybe it takes 6 months. Maybe it takes 12 months. But there is a chance if the economy ends up being a lot slower in recovery than people expect, you will see this.
That's right where I wanted to go. Lale, you're not doing the macroeconomic dance, but nevertheless, it's part of the call. Are we doing nothing more than extending out any kind of economic recovery?
Look, if you look at the initial claims and et cetera, that's what it suggests, right? The numbers are still staggering. And it's way worse than what you saw in 2008, 2009. So the economy is telling you that the recovery is going to take a little while, but the financial conditions are easy. That means, it's benefiting the investors at this point, but it's not benefiting the Main Street. But at the end of the day, I go to this simple metric. This is a zero-sum game. Bills have to be paid, revenues have to be earned, and debt has to be repaid. And this all goes in circular fashion.
How does the revenue shortfall affect debt? Coca-Cola down 28%. There are many others as well. Just as a general statement, revenue shortfall, what does that do to your world?
Well, on the leverage universe, that's difficult because, I think if you look at, so you have to differentiate between the better capitalized investment grade rated, like you highlighted Coca-Cola, for instance, versus the high yield and the leverage universe. There's a reason why companies go high yield. They carry more leverage. They are smaller. They don't have the competitive advantage in most cases, and they don't generate much free cash flow. So when you have a gap in your funding, it certainly impacts your ability to pay down your debt. not your interest. Remember, interest costs are low. So people who are looking at interest coverage are looking at the wrong metric. It only tells you that you're kicking the problem a bit further down the road. Eventually, though, business models come to a halt. Otherwise, we wouldn't have any defaults, right? We still had defaults despite QE.
Lale, what's the frothiest part of credit markets right now?
You know, I worry about the recovery play in high yield. If you look at the 2Q outperformance, you know, nearly 50% of the outperformance has come through these recovery plays as the economy opens. I think for a leverage universe, as I highlighted before, I think that's a challenge. You're seeing on the defensives, there's a lot of chasing and hiding out happening. You know, bonds are back to trading above their call prices. In investment grade on the front end, things are trading through May call prices. I mean, it's getting a little frothy. It definitely feels a little frothy.
So Greg Peters of PGIM yesterday came on and said that there still was a terrific opportunity within credit, talking about credit spreads collapsing going forward. A lot of people think this is the case just based on the Fed backstop. Where do you see possible opportunity, given what you're talking about, with fundamentals perhaps, maybe, mattering again?
Well, I think so. Credit is all about avoiding the pitfall. So I think the number one thing you can do for your clients is avoid the ones that are not going to make it through this crisis, because the tail, the negative skew, can be absolutely brutal. The number two is we're looking for what I would call second derivative plays. So companies that have, issued subordinated debt, but the cap structure is investment grade rated, where there is a pull through effect. But I'll tell you, that trade is running its course as well. And sometimes maybe you look at dividend paying equities because you may have more visibility on that cash flow. I know, isn't that strange that a credit person starts talking about equities? Look, if you're comfortable on that dividend stream, there is a price maybe that you should pay, as opposed to taking a duration and a credit risk in the credit markets.
Lale, why did you save this for the end of the interview?
Seriously.
Could have done this at the start.
Invite me back. So you can invite me back.
You know I'm going to invite you back. Lale, say my best to the family, won't you? It's always great to catch up with you. Lale Topcholu there of JOHCM. You're stunned, Tom.
It also reminds me when Bill Gross said, look at the Procter & Gamble dividend and the world stopped.
What happened to P&G after that?
He's puny compared to Lale. Well, I don't know. Who cares what the stock did? These bond people talking dividend growth, John, that really says something about the times.
It tells you about the lack of yield in the bond world right now. In your equity market, we pulled down a little bit. Still up 7 points on the S&P 500, up 0.2%. Headline of the UK I want to bring your attention to, guys. The UK reviewing development aid to China. This coming from the Prime Minister's spokesperson. Tom, just in terms of the total aid from the UK to China, about 70 million sterling. Not a huge amount, but there is a lot of aid that goes from the UK to the rest of the world. The budget has been cut to about 15 billion sterling annually. These are the kind of things that I don't think the electorate in countries like the UK really quite understand, Tom. And when they hear numbers like that, they're thinking, why are we sending money to China? And that's the debate that's playing out right now in the West, in developed countries. Why are we sending money to China when China is subsidizing companies to compete with ours?
Well, our Shannon Chen of Beijing was in Chengdu this morning, John, looking at that consulate. She actually visited the consulate this morning, and there's Wuhan. But, John, I'm sorry, I have to tilt to Hong Kong and the substantial consulates there for America and for the United Kingdom.
We are on consulate watch. Which one gets shut next? Tom Keene, Lisa Abramowitz, myself, Jonathan Ferro. This is Bloomberg Surveillance in your market right now. We advance just 6 points to the S&P 500, up in at around 0.2%. Outside of equities in the bond market, set it for the last month or so, just really sticky, in at around 60 basis points on a 10-year. Down a basis point in the day to 0.587%. Up next on the program, we'll catch up with Shannon Cross of Cross Research. A ton of earnings coming in after the close yesterday. Tesla and Microsoft, a big focus going into month end. We will hear from Apple, Facebook, and Amazon. From New York, this is Bloomberg.
With the First One News, I'm Rishika Gupta. China may retaliate for closing off of its consulate in Houston by targeting the U.S. consulate in Hong Kong. That's according to the editor of the Chinese Communist Party newspaper, Global Times. He writes that the U.S. has over 1,000 staffers there, and that means it's obviously a spy center. The editor's comments have frequently been a tip-off to what the government does. The Trump administration and Senate Republicans are considering a short-term extension of extra unemployment benefits. It's unlikely that the White House and lawmakers will agree on a broader stimulus deal before the benefits expire. Millions of Americans received the supplemental payments that were included in the last coronavirus rescue package. And President Trump is now expanding a federal law enforcement operation to Chicago and Albuquerque, New Mexico. That sets up a showdown with state and local Democratic leaders who've denounced the presence of federal agents in Portland, Oregon. The president says his goal is combating violent crime. The move is seen as an appeal to his conservative base. And Tesla is possibly paving the way for its soaring stock to join the S&P 500 index. The electric car maker reported positive earnings for the fourth quarter in a row. Still, that's not good enough for CEO Elon Musk. He thinks Tesla isn't growing fast enough. Shares, though, have quadrupled since March. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
You see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
important thing for every company to look at in the period that we've just been through has been liquidity. Do we have the cash to survive?
Survival, the key word there. That's been the key word for a lot of companies and a lot of industries over the last several months. That was Ralph Schlossstein, Evercore co-chairman and co-CEO. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your Thursday morning price action, 12 minutes away from jobless claims, shaping up as follows. Equity futures +8 on the S&P, up 0.25%. We had some weight to the benchmark for a fifth straight session. Elsewhere in the FX market, Euro was taking another look at 116, rolls over just a little bit, now unchanged at 115.68. And there we are on Treasuries, yields down by a single basis point, Tom, to 0.58%. The back end of July gets interesting. The data this morning and then the tech earnings very much in focus towards the end of the month.
Well, I agree on what we're going to see on claims here. John, we got to take 42 seconds here. And I'm sorry, the shade that Schlossstein, that's a mouthful, the shade that Schlossstein was throwing on West Street downtown was something. He really went after Goldman Sachs.
Well, I'm not going to characterize it that way, Tom. It was interesting for him to say, essentially, that if I was Goldman, this is not what I would be doing.
Yeah.
And he didn't hold back in that sense, but I'm not sure he was quite going after them in the way that you
I
described,
exaggerate.
Tom. You're going for the headlines, so to speak.
I'm just jealous of his beard. You know,
You should grow one. I think it looked great. I've seen the vacation beard on you in Jamaica. I think it looks fantastic. Go for it.
They'll be under debate today. No debate, though, on the success of technology in America. Shannon Cross, in tough times for technology, was brave enough to say, acquire shares, and someday this will pay off. Wow, has it paid off in spades, including Microsoft. Shannon Cross joins us from Cross Research. Shannon, Ralph Schlossstein there talking about cash. I believe it's 136 billion large from Microsoft. Just as a broad sense, in this tech boom, what are they going to do with all that cash?
Well, at this point, they're investing very aggressively in their core business. Spending for data center. You're seeing significant growth in their Azure and their cloud business. Slowed a little bit versus where people are expecting. But, if you look at what Azure has done, I added up in one quarter on a year-over-year basis, they grew as much as they generated 3 or 4 years ago in the total business. So Microsoft continued to focus on organic investments. And then, they've made some smart inorganic investments, GitHub, LinkedIn. They're clearly not done on that front.
There is an understanding that Amazon has a retail world that they can take out over 2, 5, 10, 20 years. There's a huge amount of growth potential for Amazon. Is it the same for the cloud and for Microsoft and Azure? Is it the same idea that the cloud just grows and grows and grows?
Well, it grows and grows. I mean, it does slow. There's law of large numbers over time, obviously. But, I think, one of the things that the COVID crisis has shown people is that remote work is something very important. Remote learn is something, at least if you have the capabilities, you may not do it. And to do that to a large extent, you need to move to a more cloud-enabled world.
There's a question about who's winning the cloud war, and Amazon seems to be very much in the forefront. Yes, they beat expectations on the part of Microsoft, but not as much as people were expecting. Are they losing this fight for market share?
No, I don't think they are. In fact, I think that they're extremely well positioned because if you think about it, Amazon was very well positioned in sort of the new economies, the internet companies, all of that. And Microsoft really where cloud is going to drive over the next several years is in that sort of mass market, middle of the country, where Microsoft has such a strong hold at this point, given all these companies have used Microsoft products for so long, they're a trusted partner. And so, yes, Amazon will continue to do well, but I think Microsoft is in an extremely good position on the cloud front.
Shannon, the idea that a unit business revenue growth of 47% is a disappointment, I think speaks to how much this company has done to raise the bar in the last couple of quarters. Satya Nadella said on the last earning calls a couple of quarters ago that we've seen 2 years of digital transformation in 2 months. Shannon, how difficult is it to keep up with what's happening at the moment for these big companies?
Well, it's interesting in talking with them last night, they're learning a lot from their own experience. So, they're seeing where their companies are, so their employees are coming back to the office and where they're not and how to be flexible. And so, I think it's kind of a brave new world for everybody, but when you think about the building blocks that Microsoft has put in place over the years, the fact that you can do subscription for all of their services, that I don't have to bring a PC into the office to have somebody set it up. It can all be done remotely, and with one email, I can have access to all the products I need. I can talk to all of my coworkers on Teams versus whether it's video or through a chat. I think their platform is something that's really sustainable. And again, one of the things that's important, I think, in this world right now is that customers need somebody that they can really trust and rely on. Because if you're a customer in the middle of the country, you may not know how to embrace cloud, but you need your tech partner to do it. And I think Microsoft is right there.
Shannon, I caught up with the PepsiCo CFO, totally different industry. He said exactly the same thing about the food and beverage business, that in this pandemic, people went to the brands they recognize, the brands they know. Does that speak to also the big get bigger in this environment?
I think you're definitely seeing that. You're certainly seeing that from a stock perspective. But, I think when you have companies that can offer a full breadth of products, whether it's Microsoft with all the software and cloud assets, if it's Dell with all of their hardware assets, there are very, and I know Dell's had some issues, but, there are certain companies, CDW on the distribution side, where their customers trust them. And I think trust is, everything's so uncertain right now. You want to feel like you can trust who you're working with. And I think that is really playing out through this pandemic.
Shannon, just quickly before we let you go, if you want a company with solid revenues, dependable profits, it's Microsoft, these big tech names. The struggle a lot of people are having on Wall Street at the moment is what they should pay for those earnings, what multiple. How do you come to that kind of decision, that calculation?
It's very difficult. I tend to be very much a value-bent person. Tom knows, I've been around a lot of the value names for a very long period of time. So, some of these multiples seem a bit stretched for me. But when you think about the companies that can generate the recurring cash flow, and then if you're an investor and you trust what the management does with the cash flow, I think people are looking at is, who can I invest in now that's going to be there in 5 years? I think to some extent, and this is not 100% true, there's less of playing like the next quarter or, the next 2 quarters. It's customers are really looking at where are we going to be in 2 years.
Shannon, really thoughtful stuff. We'll have to get you back on a program soon. Shannon Cross there, Cross Research co-founder. Tom Keene, that's the issue, isn't it? Reliable revenue growth, steady profits, a brand you trust, a management team that you trust as well. What's the premium on all of that? And this goes back to what we talked about over the last couple of hours that Lisa mentioned, the deeply negative real yields in America, pushing you out to dependable cash flow, to where names like Microsoft.
It becomes almost monopoly characteristics, and it comes down to the revenue growth and that. But I just wonder, when you sum up the market caps, John, about $5 trillion right now in the big three. I didn't count Google Alphabet there as well. As they continue to go on, at what point do people look at them like the Standard Oil Company of a few years ago?
I think we might already be there, to be honest with you, Tom, for a lot of people down in Washington.
Yeah.
Month end, Apple, Facebook, Amazon, earnings on deck towards the end of July. Coming up on this program, 5 minutes away, initial jobless claims in America. Your median estimate, 1.3 million. The breakdown will come from Bloomberg's Michael McKee. The analysis comes from him. And former New York Fed President Bill Dudley. Looking forward to that conversation on the data and some interesting picks for the Federal Reserve. That's next, right here on Bloomberg Surveillance.
those you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Inflation goal is symmetric, which means we should overshoot it. We're having a difficult time doing that, like all developed economies. I'm supportive of the idea of letting inflation get above 2% before we take any action with respect to the Fed funds rate.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro, just seconds away from initial jobless claims data in America as that crosses the Bloomberg terminal. Let's bring in Bloomberg's Michael McKee for more. Hey, Mike.
Hello, John. Well, everybody was watching to see if the recent spike in COVID cases would have an impact on jobless claims, and it has. More people off work last week. The number of initial claims, 1,416,000. That's an increase of 109,000 from the revised number last week. The expectation was for 1,300,000. Wall Street, of course, is paying attention to the continuing claims number to see if that makes a difference, if fewer people are getting claims, and that has gone down to 16,197,000. It's a decrease of 1.1 million. However, there are two things we have to keep in mind here. One, the weekly jobless claims numbers are a week old, and the continuing claims numbers are 2 weeks old. And also, the weekly jobless claims numbers don't include the extra money, the pandemic emergency money for those who were self-employed or gig workers. Another 975,000 people got that last week as initial claims. So you're looking at basically almost 2 million people getting initial jobless claims for the first time. And then the number that really matters, especially with the negotiations going on in Washington, is how many people in total are getting all different kinds of claims. 31,802,000. That is a slight decrease from 32 million last week, but it still shows there are a lot of people who are getting those $600 checks who will be affected when those stop coming at the end of the month if nothing's done down in Washington.
Mike, the right wing of the V starting to break. That's what many people are starting to expect. That's what we might be seeing play out before our eyes. The more timely measure, initial jobless claims, rising for the first time since March. Is that what you're anticipating, Mike, from the conversations you have with people, that this data is about to start rolling over?
It does look that way, and one of the important things about today's number is it represents last week, which was the week that the July payroll survey was taken. So it does put downward pressure on estimates for what might have happened in July in terms of payrolls, and of course that's the number, even if it's behind the times, even if it's a bit stale, that everybody watches to track how the economy is doing.
You know, I look, Mike McKee, at this, and just very quickly here, it is distressing, and we see immediate curve flattening. Is that just simply out there, the guesstimate that the economy will continue to slow?
Well, we're putting a lot of stock in these contemporaneous numbers, the more immediate numbers, because the staleness of the monthly data doesn't really tell us where we are. And so when you get a number like this, a big surprise, you're going to have a reaction in the markets as people start discounting what might happen ahead.
Michael McKee, thank you so much. Greatly appreciate that. Right now, something special. With us, William Dudley. He is a former president of the New York Federal Reserve. There are 8, 9, 10 topics that we could speak to William Dudley about, but there is only one topic for those of economics, and you've seen it percolate. We've done it on this show as well, and that is a new governor at the Federal Reserve System. Her name is Judy Shelton. She has an education degree from Portland State University, which is 624 miles from Bill Dudley's PhD at Berkeley. This is a delicate conversation, Bill Dudley, but let me begin with a blunt question. How does this system deal with a potential governor this uniquely qualified?
I don't think it creates huge amounts of problems. There have been governors in the past that have been outside the mainstream. Wayne Angel is someone who comes to mind. And the Fed, there's 7 governors. There will be 7 governors if Waller and Shelton are confirmed. And I think they will have a voice, but they will not actually set the path for monetary policy or regulatory policy at the Fed. They'll be set by Jay Powell and Randy Quarles.
The heart of her theory is the yearning to go back to another time of a more closed American system, a more static economy. To the many people that support Judy Shelton and that desire, that feeling of another time and place, how do you respond in this time of an open America and open economy?
Well, she has advocated returning to the gold standard, and returning to the gold standard would result in tremendous increase in the volatility of interest rates, because basically when gold prices were going up, the Federal Reserve would have to raise rates. When gold prices were going down, the Federal Reserve would have to lower interest rates, regardless of what was happening in the real economy, regardless of what was happening to inflation, regardless of what was happening to the unemployment rate. The gold standard is not a good anchor for U.S. monetary policy.
Bill, let's talk about the real economy. How would you be reacting now to the data that's starting to come through in America? We saw it in the high-frequency data. We got a flavor that things were starting to stall, to roll over. Now we see it in jobless claims as well. They're starting to pick up again. I said a couple of moments ago that it looks like the right wing of that V is starting to break. What would that mean for you as a policymaker at the Fed again?
Well, I think what's happening is the recovery in economic activity is flattening out as shutdowns are recurring and social distancing is increasing again. And I don't think we're going to see a fall back to where we were, in March, April, and May. But the recovery is going to be quite subdued. The unemployment rate is going to stay high for quite some time. And as a consequence of that, monetary policy is going to be on hold. And the Federal Reserve is going to be looking around for what things can they do to provide additional monetary policy.
What things do you think they can and should do in the months to come?
Well, I think, unfortunately, they don't have a lot of great weapons. I think they're going to continue their large-scale asset purchases, buying treasuries and agency mortgage-backed securities. They may come forward with more definitive forward guidance in terms of keeping interest rates low for long until the unemployment rate falls below a particular level or inflation climbs above a particular level. But the real focus right now should be on fiscal policy. That's what the U.S. economy needs. We're basically right at the edge of a huge fiscal cliff with the expiration of the $600 a week unemployment compensation benefits at the end of this month. And if that's not replaced by something significant soon, the economy is actually going to be weaker than people anticipate.
Bill, Fed Chair Jay Powell also agreeing with you, coming out and saying fiscal policy is necessary, but the Fed has control over monetary policy, and right now monetary policy is pushing investors into equities. We're looking at futures right now unchanged or a little bit higher on the day ahead of the open. Even after these worsening labor statistics, how much should the equity market be a gauge of financial conditions for the Federal Reserve, something to shoot for, with higher equity values being a good thing?
I don't think the Fed wants the equity market to go to any particular level. They do want financial conditions to be accommodative. They want markets to work. They want markets to be open and well-functioning. And I think that's what they've achieved. I think there are some people on the Federal Reserve that are a little bit concerned about how high the equity market is. In the last FOMC minutes, you saw a couple of people talking about financial stability issues. I personally think the stock market is high mainly because bond yields are low. And bond yields are low because monetary policy is going to be very accommodative for a number of years.
Well, but to the extent that the Fed is worried about the widening gap between wealthy and poorer individuals, how concerning is it that their policies have pushed up asset prices, have created easier financial conditions, but clearly are not leading to a better labor market, given the fact that we're seeing a reversal in the claims numbers?
Well, I think they are, frustrated by the fact that they don't have good tools to address the issue of income inequality. I think they wish they did have better tools, but monetary policy is not well suited for that. Fiscal policy is. So it's really for Congress and the administration to do things on fiscal policy that help address the fact that the burden of the pandemic is falling disproportionately on low and moderate income households.
Bill Dudley with us, and we will continue with the former president of the New York Fed. We welcome all of you on Bloomberg Radio and Bloomberg Television. As John Farrow notes, a flip in the market here. Futures come back, dollar stronger. And John, we've got to look as we continue with Bill Dudley. John, we've got to look at this substantial curve flattening. It's really broken down.
Long end in by 2 basis points to about 127 on a 30-year. Bill, talk to me about the QE program and the scope for adjusting that to sit at the long end just a little bit more. The front end is already so well anchored. What can you do at the long end, and what did you learn coming out of the last crisis?
Well, the Fed historically has used their large-scale asset purchases to buy treasuries across the yield curve. They could decide to buy more longer maturity treasuries, since, as you point out, the short end of the treasury market is well anchored by expectations the Fed's not going to move for several years. The Fed has indicated that they're going to shift their large-scale asset purchase programs from focusing on market function, which is now good, to focusing on how do you actually stimulate the economy. I think that it does imply that they're going to buy a greater proportion of longer-dated treasuries.
Bill, before we let you go, I need a message for fiscal policymakers down in Washington. There's a real discussion about perhaps allowing the enhanced unemployment benefits to expire, maybe to taper them aggressively. Maybe that's the best case that we can hope for out of the administration and Republicans. If that happens, what do you expect August and September data to look like, Bill?
Well, again, I think it's going to depend more on the course of the pandemic and what social distancing that then requires. But if there is no extension of unemployment compensation benefits, then I think you will see consequences for consumer spending. But consumer spending has held up reasonably well, in part because household incomes have been well supported by fiscal policy. If that support ends, the consequences, what we're seeing in the labor market, are going to start to become more important in terms of household outlays.
Bill, appreciate your time this morning. Appreciate your patience too. Great to catch up with you. William Dudley there, former New York Fed president. Tom Keene, we're breaking down a bit. Equity futures aren't doing a whole lot, but to see that in the data in the way that people expected, people worried about. The last couple of months and the huge upside surprises we saw in the payrolls report, for so many economists, that wasn't an indication of what was to come. The risk was that you extrapolated out that improvement too far, too quickly. We're learning that the recovery is constrained, and we're just starting to see it in the data. The initial jobless claims for the first time.
I can't emphasize enough, John, the importance of the mathiness here. I look at a whole series of fancy moving averages, and the series is beyond elegant of a glide path in the vicinity of where we are. I'm not predicting up or down from here on claims, but John, it's unimaginable to everyone listening, watching, every expert we talk to, that we sustain over 1 million units per every Thursday on claims. It's not in the realm of anyone's thinking that we sustain at 1 million claims.
If there's one data point that sharpens the focus down in Washington, D.C., it's got to be the data point that speaks to the labor market. In your market right now, let's get to the price action. Equity futures positive by just 5 points, up a little more than 1/10%. Tom Keene speaking to a flatter yield curve. That's where we're at. The front end anchored. The 30-year comes in 2 basis points to 1.276%. Jobless claims in America rising for the first time since March. Will it continue? And does it speak to an economy that's starting to stall? Up next on this program, Phil Camporelli, JP Morgan Asset Management investment specialist. Heard on Bloomberg Radio, seen on Bloomberg TV from New York. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The world has now gone over 50 million coronavirus cases. The US, Brazil, and India account for nearly half of all infections. Texas reported 197 deaths. That's the most ever in one day. And in Florida, Governor Ron DeSantis says schools may delay reopening if they need time to protect against the risk of the virus. In the UK, a panel of lawmakers says that Boris Johnson's government had no economic plan for the pandemic. According to the House of Commons Public Accounts Committee, the economic response to the coronavirus was, quote, rushed and reactive. That's despite it being identified as a top risk for years. And the fight over the Chinese consulate in Houston shows that hardliners now have the upper hand in the Trump administration. President Trump has allowed a small group of advisors, led by Secretary of State Mike Pompeo, to push U.S. policy towards its most antagonistic in decades. U.S. officials say that China has a history of espionage and intellectual property theft. In an excerpt from a video released today, Joe Biden discusses the death of his son with President Obama. The Democratic presidential candidate recalled it in the context of protections provided by Obamacare. Biden said he wondered what it would have been like in the middle of treatment to hear that insurance had run out. He said that could have happened before Obamacare. And the parent of Mercedes-Benz expects to make an operating profit this year. Second quarter results signal that Daimler weathered the unprecedented industry slump better than expected. The company is counting on the economy improving and no second wave of the coronavirus. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
As we go into September, the risks are very much skewed towards a more aggressive Fed, which compresses yields, flattens the U.S. curve, and in turn that would be an additional dollar negative dynamic.
George Saravelos there of Deutsche Bank on this FX market and the risks around this economy as well. Tom Keene, initial jobless claims rising for the first time since March. I'll be catching up with Priya Misra of TD Securities on that. A crucial discussion. Are we starting to see the right end of that wing of that V start to break down? Are things starting to stall?
John Farrow now off to the open, and it's going to be an important and changed open because, folks, we see a data check right now that is different than where it was at 829. Yields have come in, and now we have a second tranche of lower yields off of the 830 statistic. 30-year bond, very importantly, printing a 1.26, right now 1.27. 10-year yield comes in a solid 2 basis points as well. 2-year hasn't broken in yet, but there is curve flattening. Right now, to bring the conversation forward with a real observation on flows is Philip Camporial of JP Morgan Asset Management. We're thrilled he could join us this morning. Phil, you've got a great statistic of the money walking out of equity, the money walking out of bonds. Tell us what flows tell you now.
Yeah, good morning, Tom. What it says to us is that equities in general are under-owned. If you look at the U.S. equity mutual fund complex, it saw a record 72 billion in outflows in the second quarter. But the really important one was international equities. And this is where we think the opportunity is. International equities have been sold since 2017. It had a record 65 billion in outflows in the second quarter. But I can't impress upon you enough, Tom, how important that fiscal announcement was this week by Europe. And it was 8 years in the making. Tom, it was almost to the day. It was July 26th. 2012, when Mario Draghi, in his famous Bumblebee speech, said, "We're going to do whatever it takes to preserve the euro. Trust me, it'll work."
You're making me feel old.
Well,
yeah,
Phil,
and you know what?
Well, Phil, this has been an amazing moment. I will say this has been a really pivotal moment for the euro region, and we're seeing this with respect to the dollar breaking down versus the euro gaining strength. How much is your international equities call a call on a weaker dollar?
Yeah, so that's part of it. You need that to happen. Similar to 2017, that was the last year when the Morgan Stanley All Country World Index outperformed the U.S. And ever since then, it's just been a one-way U.S. trade. So you need the dollar weakness for the U.S. investor investing abroad. But you also need a catalyst. And the catalyst right now is that not only is baseball starting tonight, but we think we're in the early innings of a new business cycle. And this is rare. I mean, we're seeing the largest percent of countries with an increase in their PMIs since 2009.
Well, hold on a second, Phil. That doesn't necessarily, though, mean a change in a business cycle. In other words, the start of a new upward tilt. This could just be, what base are we coming off of? This has been a historic moment where the entire world shut down based on the pandemic. Doesn't that factor in here?
Yes, but the base case here is that policymakers not only are willing to avoid the worst case scenario, but they have the ability to do it. The powerful combination of monetary and fiscal policy. And the initial jobless claims this morning, that should be sent right to Congress, right? It should be, okay, here's why Chairman Powell is saying we're not even thinking about raising rates. It's because we believe that there's going to be a 10% or 9% unemployment rate at the end of this year. That's not going anywhere, and very slow improvement next year. That's really the bottom line here, is that powerful combination of monetary and fiscal policy, it's tough to take the other side.
The bottom line is we're with Philip Camporial of JP Morgan, and we do this with Markets on the Move. We welcome all of you on Bloomberg Radio and Bloomberg Television. Futures green on the screen and nicely green on the screen through the morning. They do an abrupt reversal. Futures at -2, Dow futures -33. Even the VIX with that 23 handles come out a little bit of angst in the market, 24.52. 2-year yield even finally breaks to a slightly lower yield. The 10-year in with a vengeance, 2 basis points. A 30-year bond in 3 basis points, 1.2645. Phil, there is a fear that's out there, as I began in your note, of the flows that are out there. It's an unloved market. Is tech unloved?
So tech is probably the one that's most loved, right? Because tech became not only a way to get upside in the equity market, but it also became a defensive trade. Every kind of headline that you saw that was negative on the virus, tech would rally, right? So I wouldn't say that tech is unloved, but man almighty, if you look at the price to book of the Russell 2000 versus the S&P, Tom, it's only been cheaper 3% of the time over the last 20 years, right? So even though the market is trading at high levels, we think that there are plenty of places, including Europe, right, with the value story that rotation is going to happen.
Phil, this has been really valuable, very numerical. Thank you so much. Philip Campariel with JP Morgan with some really great data there on this unloved market. Futures flat right now. Lisa, we need to sum up. Over in the Death Star, we had the Secretary of Treasury speaking, and over with Fox Biz Maria, we had Mr. Kudlow speaking. They don't want to speak to us today, given these challenges that are out there. And one of them from the Secretary was the challenge of getting Republicans all on board.
Yeah, and that does seem to be moving forward with some sort of stopgap measure, right? That's the worry here, is the concern that you have this fiscal cliff, and then are we just going to get another fiscal cliff when they finish coming up with a temporary enhanced unemployment benefit extension? I will say, talking about the Death Star, we do have Treasury Secretary Steve Mnuchin saying that no payroll tax cut is in the Senate GOP base stimulus bill. This has been a huge point of contention with respect to both Democrats and Republicans, even though President Trump wants it. So we'll be viewed as a positive to getting something through.
Oh, then they can delay, they can move the can down the road on part of this. But really, folks, I get out, Lisa, the calendar, and I know what you're going to say. It's July 23, and yeah, it's about fancy people in suits and dresses. What it's really about, the rent's due August 1 for millions and millions of people in America.
Yeah.
And flat out, Lisa, they can't pay it.
Well, and this is the big issue, is that where is the political will to not pass some sort of extension here? Right now, I should just note that S&P futures did turn positive based on this idea that we are going to get some sort of extension. Or, I mean, look, this is a minor move, but if you're going to read into it, that's what I would read into it. Interesting to see going forward how the White House spins the worsening labor market. Yeah. How inevitable was this versus a perhaps less effective health policy in controlling the virus, Tom?
Well, to set up for the next hour, let me do a data check, and I'm going to fold in here some of the nuances through the day. I wonder if the president's speaking at 5 p.m. This afternoon. That will be interesting. What you need to know right now is off claims and perhaps off the comments from the Trump administration. Yields are in, and we've had a decisive breakdown in that difference in yield between the 10-year and the 2-year, the so-called 2-10 spread. 43.05. If you're not part of global Wall Street, you know, it's just a number. What you need to know, it signifies what's called curve flattening, and that is a 10-year yield coming in with a vengeance compared to what the yield you get for 2-year paper. This is really, really important. It's been widely anticipated by those exceptionally cautious. It'll be interesting to see then how it redounds over to equities, where we were up, 16, 17, 18 in futures, and now we're -1 on SPX. This sets us up for an eventful morning. John Farrow out in the open on Bloomberg Television. Paul Sweeney and I can't wait to talk to Paul Sweeney about Microsoft's forward view. Stay with us. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
None of us are safe until all of us are safe. We need to have a global approach into handling and fighting COVID-19, a global pandemic. Part of this, of course, finding an effective vaccine.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our viewers worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the open in Powell. With equity futures fading, let's begin with the big issues. Senate Majority Leader Mitch McConnell hoping to unveil the GOP's stimulus bill. One major sticking point, enhanced unemployment benefits. Republicans said to be discussing a short-term extension. Scope remaining unclear, though it would be treated as separate from the $1 trillion cap Senate Republicans want to adhere to. Ohio Senator Rob Portman weighing in.
Most of us agree there needs to be something in its place. Most of us also agree, by the way, that the $600 flat amount for every worker is not a good idea going forward because it's creating a disincentive to work. This is a crisis. You know, we need to respond to it. We can't play politics as usual here. And if we do that, I think we can get something done, even by the end of next week.
The problem is it feels like politics as usual. Senate Minority Leader Chuck Schumer not holding back.
The Republican Party is so disorganized, chaotic, and unprepared that they can barely cobble together a partisan bill in their own conference. The disarray on the Republican side has real consequences. Americans will suffer unnecessary pain and uncertainty because of it.
We already started to see the data fade. Initial jobless claims in America rising for the first time since March. I want to bring in Kevin Cirilli, Bloomberg Chief, Washington correspondent. Kevin, the data should sharpen the focus down in Washington, D.C. Will it?
But yes, I think it will. And in fact, just moments ago, Bloomberg government reporting off of a CNBC interview with Treasury Secretary Steven Mnuchin that the payroll tax holiday will not be included in Leader McConnell's stimulus proposal that we are anticipating sometime in the next couple of hours, as early as the next couple of hours. So the payroll tax holiday, something that President Trump has said that he wanted in this next round of stimulus, is not going to be included, according to the Treasury Secretary, in the next round of stimulus. That is a major concession from the White House, given that they had pushed for this so much. But we should also note that this debate does not stop here. Once we get through this round of economic stimulus, Jonathan, there's likely going to be another fight over another potential round of stimulus come the fall, and expect this issue to come back right before the election.
Kevin, the payroll tax cut was a non-starter from the beginning. Yeah. Walk me through where we have some separation beyond just size between the Democrats and Republicans right now.
For Leader McConnell, it's about liability protections. For Speaker Pelosi and Democrats, it's about funding for underserved communities and including rent assistance and the growing rent crisis in America. But there are also a series of tax credits for the private sector that are going to be incredibly fascinating to watch, including the notion of providing tax credits to companies and corporations, Jonathan, that might have to furlough or lay off workers by the end of the year. If they keep them on their payroll, they could qualify for some significant financial assistance. The tension right now, and this is the ideological broader view, if you're outside of Washington, the tension right now is it safer to provide financial assistance to people who are out of work, Or is it better for the country to provide incentive to get employees safely back to work? And that is where all of this is coming from.
With an economy still constrained and struggling to normalise, you've got to do a mix of both. Kevin, the conversation, we will continue. Joining us now is Priya Misra of TD Securities. Priya, the data starting to break the wrong way. Priya, it's only one data point, and I should emphasise, I should stress that, but we've been waiting for this data point, and we're waiting for more. The right wing of the V to break, to roll over. Are you expected to see more of the same?
Unfortunately, I do. I think the V-shaped recovery is very hard to see with continued virus cases. Also, I think a lot of the data we've seen of late has been stimulus impacted. And as the stimulus rolls off, and remember, we're not talking about another $3 trillion CARES package. Even if we get consensus and, you know, the two sides still seem far apart, but even if you get $1 trillion, we're talking about $1.5 trillion. So you're not going to get that same kind of stimulus. So I see a very choppy recovery. We've sort of run out of what alphabet letter that is. It's not, I'm not even sure it's a U. Is it a Nike swoosh with a jagged end? That's sort of a bumpy recovery in an environment where we have to just live with this virus, and that's going to impact confidence, business as well as consumer.
Priya, there's a huge debate over the enhanced unemployment benefits. I think it's a ridiculous one. You can make the projection that at some point it might weigh on labour supply. I don't think there's any evidence whatsoever right now in the aggregate data that that's the case. The idea that wages went down in the last payrolls report speaks to the low-wage segment coming back to work. There is a huge amount of people out of work and not enough jobs available for them to fill. Priya, if they don't extend the enhanced unemployment benefits in some shape or form, can this get a whole lot worse?
I think it can, yes. I do think that Congress gets it. And whether it's one phase or, you know, some stimulus, maybe it's not called an unemployment insurance, but it's called a stimulus check. I think we realize that consumer spending has been holding up well, largely due to the stimulus payment. So in whichever way they get it done, I think they get it. So I'm a little bit more optimistic on that front. But absolutely, if we don't get that, I think you're going to see consumer spending fall off a cliff in an environment where we're living with more virus cases. In any way, there isn't that much incentive to spend. And now you take away that cash payment. I think it's a very big deal.
Well, let's talk about that dire backdrop, Priya, and how you should push it through this bond market right now. The front end is just pinned to the floor. The long end, some scope to rally maybe. Your yield right now at a 30-year at 126. Are you looking for that flatter curve?
I am, yes. I'm looking for a flatter curve and I'm looking for lower rates. And it's a little out of consensus because we've been in this for the 10-year. We've been in the 60 to 80 basis point range now since mid-March. And so I think a lot of people are playing for us to go back into the range. But I'm a little cautious over the next couple of months. We've got seasonals in August that are pretty positive for duration. We have a Fed that's extremely dovish. And, you know, we have a meeting coming up next week. I don't know if it's next week or the September meeting, but I think the Fed is going to shift the narrative of QE. I think they're going to move away from market functioning to keeping long-end rates contained. And that means they're going to be buying a lot more long-end treasuries. So as this QE, and the market's starting to price this in, but I don't think we're fully there. And we have an election. Markets don't like uncertainty. These binary risks, which are impossible to hedge. Yeah. With an equity market near its highs, I think buying some treasuries for safe haven makes sense here, which is why I actually think we test the lows in 10-year treasuries over the next couple of months.
Priya, that Fed shift, how do they formalize that? Is that something they say explicitly in a statement, in a news conference, or just something they start doing?
I think they'll have to formally state it because they've been keeping the proportion of buying remarkably stable over the last few months. Ever since QE began, they've been buying in proportion to outstanding treasuries. I think so they have to make the statement, and they've been talking about market functioning. They have to teach, you know, they don't need to tell us exactly how much they're going to buy in the long end, but at least tell us that the focus now is long end rates. This is, I hate saying it, is normal QE. I mean, this is the QE that we were used to pre, COVID. So 2010 QE, 2013 QE. That's the QE we're going back to. I think they have to make that statement, but it's a little tricky. If they just do that right now, the front end can get unhinged. So I think the Fed makes that switch of QE narrative along with explicitly telling us that they are not about to hike anytime soon, that they are very serious about inflation. And to be fair, what they're talking about in terms of inflation forward guidance, if this was the policy they had in 2015, we wouldn't even have seen the first Fed hike in 2015. So it's a very dovish reaction function. But it's kind of linked. I think I see the two linked.
Conditioned by the experience of the last several years. Priya, lucky to have you on this morning. Brilliant to catch up. Priya Misra of TD Securities. In your equity market, we roll over a little bit. Claims data, it's a subtle shift, but an important one. Bloomberg's Michael McKee taking a look. Hey, Mike.
Good morning, John. Yes, it is the kind of thing that we expected, although it may be taking markets a little bit by surprise. The rise of COVID cases across the country and the move by governors to shut down at least some businesses again put more people on the unemployment rolls. 1.42 million, 1,416,000 people. That's an increase of 109,000 over the prior week. The number of people getting pandemic assistance, the additional assistance for people who were self-employed or gig workers, up by 975,000. That's a 20,000 gain. So the number's moving in the wrong direction. And then when you take a look at the total number of people getting benefits under all of the various programs that the government provides, still 31 million people. And that tells you, John, that there is a lot riding on what happens down in Washington with that unemployment insurance and the CARES 2 bill.
Mike, is there any evidence whatsoever, right now with the data, not a projection, right now, what we've already experienced in the realized economic data, that the enhanced unemployment benefits is holding back labor supply?
Now, when you look at the flows in and out of the labor market, which this is a flow of people out of the labor market, but flows in, do not suggest that there is a problem with that. People are going back to work when their companies open. There are anecdotal reports that some people don't want to go back, but there doesn't seem to be anything in the data that shows us that at this point. People do want to get jobs, get back to work, and they also know this fiscal cliff is coming, so it doesn't seem to be something that is influencing the labor market right now.
Mike, there's a massive trade-off here, isn't there? You can make the political decision, and I'm not going to weigh in on that you should be paid more to do a job than paid to not have a job. You can make that argument. But if you're going to make an economic argument, there's a massive trade-off here. If you cut those benefits, consumption is held up in America over the last several months because people have had an offset to the income shock. If that fades aggressively in the coming months, Mike, inevitably, this economy is going to take a hit.
It is, and that's going to be a downward spiral, because if the economy takes a hit, then some of those people who went back to work won't have any customers, and they'll lose their jobs again. So it is something that they need to definitely keep in mind as they try to craft a new program, that you need to taper something like this. You can't just cut it off cold turkey.
We'll find out what they plan to do down in Washington sometime soon. Mike, stay close. We've got to talk about China. Coming up next on the program, the tension between China and the United States and the opportunity in this equity market. The fantastic, the brilliant Mandy Zhu, Credit Suisse Chief Equity Derivative Strategist, coming up next on Bloomberg TV.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
we are setting out clear expectations for how the Chinese Communist Party is going to behave. And when they don't, we're going to take actions that protect the American people.
U.S. Secretary of State Mike Pompeo there defending the decision to close the Chinese consulate in Houston. China responding by warning the United States to proceed with caution. A foreign ministry spokesman saying the following: China's position on the China-U.S. relationship is clear and consistent. As to which direction this relationship is heading, it's an issue for the United States to carefully think about. Bloomberg's Mike McKee back with us. Mike, we're on consulate watch in mainland China and maybe even in Hong Kong as well. What are you looking for?
Well, right now, John, the wait is on for what the Chinese are going to do to retaliate. They've all but promised that they're going to do that. Reuters reporting that the Chinese were going to close the consulate in Wuhan, while the South China Morning Post is saying it's going to be the consulate in Chengdu. Now, the Wuhan consulate is being run by a skeleton staff now. It was shut down during the coronavirus pandemic, and only a handful of diplomats have returned, while the Chengdu consulate is an important monitoring post for what happens in Tibet. Now, Hu Xijin, the editor-in-chief of the Global Times, you know him, often seen as an unofficial spokesman for the Chinese government, says the Chinese would move to inflict more pain on the U.S. than just closing the consulate in Wuhan, including potential cuts to the Hong Kong consulate, important because thousands of people, Americans, live there. The U.S. has over 1,000 staff at the Hong Kong consulate who says, what are so many people doing? It's obviously a spy center. He suggested they could cut those 1,000 people to 100 or 200. The official foreign ministry spokesman saying nothing in particular other than reiterating that the Chinese will retaliate at some point. Now, the interesting thing so far, the markets taking all of this in stride. Equity markets in China down a little bit, but in the U.S. they have been up. The yuan is strengthening again on the day, and soybean prices have rebounded, coming back. China reportedly continuing to buy under the terms of that Phase 1 agreement. So those who were worried that this might put the kibosh on that, it doesn't seem to be happening at the moment. One note on the potential for retaliation for you and Tom Keene, John, particularly. Tensions rising between the UK and China as well. The Chinese have taken the Premier League off TV in China.
Tom Keene's very upset that he's going to miss Spurs Crystal Palace. At least that's what he told me a couple of hours ago. Mike, always great to catch up with you, sir. Michael McKee there on the tension between the United States and China and the rest of the world for that matter. The last time we saw this happen in a big way a couple of years ago, and it continued from there on, was over trade. And when it was over trade and tariffs, there was a clear read across for this market. Tension up, tariffs on, tariffs off. It was that kind of conversation. You knew what to do with it. And in that environment, U.S. equities did quite well. What does it mean for U.S. equities now versus the rest of the world, and with Europe stuck somewhere in between? This is what Mandy Zhu has got to say on Europe. After years of underperforming, Europe now has a better economic outlook, largely a result of getting the virus under control, and a better geopolitical outlook as well. Tighter fiscal integration versus the United States, facing a fiscal cliff and an election. Mandy Zhu joins us now. Mandy, fantastic to catch up with you. We'll talk about the trade in a moment. Just talk me through the framework for the trade, why you're that little bit more optimistic on Europe.
Sure. It's great to be on the show. So as you mentioned before, I think Europe has always had a structural flaw, which is that they had a monetary union without a fiscal union, right? And that's why, when the EU Recovery Fund, when the news first broke, we said it was a big momentous moment for the region because it is the first step towards tighter fiscal integration. So that, to us, is a tailwind for the region. But more than that, I think our thesis is on the pandemic and the fact that the two regions have taken two drastically different approaches to the virus. And as a result, what you're seeing in Europe now is Europe has the virus under control. And as a result of crushing the virus, restaurants and bars are opening up, kids are opening up for indoor dining. Kids are going back to school in the fall, and even soccer games are back on with fans in the stadium, right? Whereas in the U.S., more and more the incremental news flow is around localities closing things, right? As a result of the surge in the virus and in cases. So we have schools, more school districts closing in the fall. We have restaurants and retail activity slowing down. And to give you a sense of how different the picture is in the U.S., Texas is even talking about shutting down high school football. So I think as a result of the diverging virus trend, our economists are forecasting a much faster economic pickup growth in Europe compared to the U.S. So this is, I think, a case where you have in Europe, better fundamentals, better economic fundamentals, as well as a positive political tailwind, whereas in the U.S., as I mentioned earlier, you have the U.S. election, as well as the upcoming fiscal cliff. So I think macroeconomically, that's where we stand in terms of how do you trade it.
Yeah.
We like buying upside calls in Euro stocks and funding it by selling upside calls in S&P. That is a very simple level, one way you can take advantage of this diverging trend that we talked about. On the vol side, that also makes sense because Euro stocks vols are currently trading at very depressed levels relative to S&P. So you're buying Euro stocks vol, selling S&P vol. That we like it from the vol side, and we also like it from the directional side.
Mandy, can you talk to me about the sector bets implicit in the positioning around some of those indexes? Is that part of the thinking too?
Yeah, so the one pushback, I would say the most common pushback we get to this type of calls when we talk about European outperformance relative to S&P is that it is implicitly a value versus growth trade, right? Because in Europe, there really isn't much, tech weighting. It's much more heavy, much more significant weighting to the cyclical value sectors. So one way, if you don't want to take that value versus growth factor tilt, and a lot of investors don't, you can look at, for example, emerging markets over S&P. We also like that because, again, a lot of the EM countries, China, Korea, Taiwan, they've crushed the virus as well, right? And in EM, they have a similar tech weighting to the S&P. So if you don't want to take the factor or the sector tilt, you can look at emerging markets over S&P, but which we also like from a fundamental perspective as well.
Mandy, the other trade I wanted to talk about was the S&P versus, say, the NASDAQ and big tech. Something that you've mentioned is the QQQs versus SPX implied vol. That spread hit a record last week. Can you walk us through what that actually means and the opportunity that presents?
Yes. So what we've seen is going into this earnings season, a very notable bid to large cap tech vols. And what that has resulted is, like you mentioned, the NASDAQ S&P vol spread reaching a record high last week. This is a record going back to the mid-2000s. So, outside of the tech bubble, this is as big of a premium as we've seen to NASDAQ vols relative to S&P. Now, has NASDAQ ever realized volatility of as high, this was around 10 points last week? Well, over the past 15 years, the only time NASDAQ has actually realized volatility of that high versus the S&P was in the fourth quarter of 2018, which, if you recall, was a tech-led sell-off that was exacerbated by very crowded hedge fund positioning in the tech sector. So, there's some parallels to this current setup where we're also seeing very high concentration and high crowding in the tech sector. But I would argue this time around, the primary risk driving market is not uncertainty around tech earnings. It's the pandemic, right, and the economic fallout from the pandemic. And tech is actually one of the more insulated sectors from the ongoing pandemic risk, which is why over the past, few months, tech actually consistently realized volatilities that are lower than the S&P. It's a relative safe haven in this environment, which is why it has done so well performance-wise this year. So to me, that bid to tech, large cap tech vols looks overdone. We like taking advantage of that. If you're a fundamental investor, taking advantage of that pop and vol by overwriting or underwriting your core tech position, or from the relative vol side, we like selling tech vols, buying S&P vols as a way to take advantage of this bid to large cap tech vol.
Mandy, really, really interesting stuff. Some interesting trades in the mix as well. Send my best to the team, won't you? Mandy Zhu there at Credit Suisse. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls, and later a conversation on big tech earnings coming into focus following Microsoft's quarterly results. Dan Ives of Wedbush, the equity research managing director. He'll be with us after the opening bell. Equity futures flat going into the cash open. From New York, this is Bloomberg.
As COVID-19 halted the economy, retail investors turned to stocks, looking to gain on the market swings. We'll explore this trend on a Bloomberg special report, Markets Meltdown, this weekend on Bloomberg Television.
6 minutes from the cash open in New York, equities rolling over just a little bit. Equity futures were negative around about a point or two on the S&P 500. Here's the cross-asset story. Treasuries in by 2 basis points on a 10-year to 0.58%, a flatter curve off the back of some disappointing initial jobless claims in America. Euro dollar 115.56. We took a sneak peek at 116 in yesterday's session. We did have a 116 print. We're back to 115.57 now. Dollar yen has been a total snooze going all the way back to the end of January. Despite all the volatility, it's been 107 after 107 after 107 after 107, and today 107.16. That's your cross-asset story. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Guggenheim downgrading Kraft Heinz to a sell with a $30 price target. The analysts expecting the pandemic to negatively impact its market share across key categories. Next up, Cowen upgrading Tesla to market perform following earnings. The analyst nearly quadrupling his price target, raising estimates up to $1,100 from $300 a share, citing impressive quarterly results that blew away expectations. Their stock is positive in the pre-market by around about 4.5%. Your third and final call, it comes from the team at Oppenheimer, downgrading Microsoft to market perform from outperform following fourth quarter results. The analysts citing slowing cloud growth and increasing competition. The stock down in early trading by about 2%. Coming up on the program, Dan Ives of Wedbush weighing in on big tech. In your market right now, 5 minutes away from the opening bell. Call it 4. Equity futures fade from New York. This is Bloomberg.